The VIPs arrived to the earnings party live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S., you actually have a little bit of a rally on our hands. The S&P 500 up about 0.4%. The NASDAQ 100, your big tech names, up about 0.5%. Of course, as Romaine mentioned, we're heading into the heart of earnings season with Alphabet and Microsoft taking the stage after the bell. So we'll see how those lines change. But you take a look at the bond market, a little bit of a bid there, too, just barely. The 10-year yield down about 1 basis point. I did want to check in on crude oil because you've seen a little bit of a downdraft that's continuing today. You have crude oil off by about almost 2%, Romaine. Yeah, interesting, though, Katie. You didn't have your favorite up there, Bitcoin. In fact, one of the biggest rallies that we're actually seeing right now to start the week, of course, involves the almost forgotten Rip Van Winkle crypto trade. Bitcoin posting its biggest one-day gain going back to March. A lot of intense and somewhat credible speculation, I may add, about regulatory approval of the first U.S. spot Bitcoin ETFs. Bloomberg intelligence analyst Eric Balchunas, friend of Katie Greifeld, flagged this on social media, noting that the iShares Bitcoin Trust has been listed at the Depository Trust Clearing Corporation with the ticker IBTC. While that approval is still no guarantee, Balchunas says that when you see a ticker added, those things are usually right before a launch. Meanwhile, the meat of the earnings season is upon us here, arriving tonight with reports from Microsoft and Apple, the second and fifth highest weighted members of the S&P 500. Remember, about 37% of the gains that we've seen in the S&P this year are tied solely to those two companies. So as they go, so goes the broader market. Now, the good news is Alphabet's net revenue likely grew at its fastest pace in 5 quarters. And while Microsoft's sales growth has softened, profitability is still growing at double-digit percentage rates. Still, a good earnings report might not be enough when you consider that rising rates, Katie Greifeld, have made already stretched big tech valuations look even more expensive, with that group remaining the most crowded trade out there. The most crowded trade out there, and for good reason, because you reflect back on the year that the Magnificent Seven in particular has had. I mean, it has just been an incredible run. You can see it in white. That's the market cap that has been added by the Big Seven. Then you take a look at the S&P 500 market cap. Without those 7 names, it would actually be lower on the year. So, of course, that small group of select big tech names really carrying the entire benchmark this entire year. But as Romaine mentioned, of course, we have seen rates rise, and that has had an impact on the equity market overall. But it's worth noting that even with that, you've seen big tech hold up remarkably well. You can see that divergence there. Of course, as yields go higher, it's on a subversion right there. So you can see that gap has formed, but still a remarkable performance by big tech, really resilient even in the face of rising rates. We'll see how long that dynamic can continue. All right, let's kick off the close right now with Dan Greenhaus, chief economist and strategist over at Solus Alternative Asset Management, joining us here in Studio 2. Great to have you here on set, Dan. Thanks for having me. Obviously, this is going to be an incredibly busy week, and really kind of have to put it in the context of the next 2 weeks with a couple hundred earnings coming out of the big names. Obviously, you get a Fed meeting next week here. What do you think the market wants to hear from most? Do they still want to hear about the macro conditions, about the Fed and rates, or are they more focused on corporate fundamentals and the bottom line?
I think right now the focus is entirely on interest rates, and I don't think that's a particularly groundbreaking observation to make. You look at the performance of the equity market yesterday, for instance, in the face of that rate reversal, the only explanatory variable to which you could point would be the change in rates. Excuse me. So I think the Fed meeting next week becomes crucially important on that front. But at the same time, earnings are going quite well. Companies aren't telling us that anyone's falling off the cliff. I would point to American Express, for instance, suggesting strength in at least the high-end consumer. So I think the combination of everything, but right now the focus is on rates. Well, you talk about rates, and obviously we know that's really been the tail wagging the dog for this market for quite some time. And there's a question as to whether we've reached the peak, and more importantly, if that peak is in where we are right now, can the market actually live with that? Because for right now, they're still kind of, splashing the water and throwing a tantrum. In general, I think rate of change is much more important than levels. And so to the extent that the market is having trouble right now, and it most certainly is, it's digesting the speed of the move and the speed of the adjustment rather than the level itself. I think what a lot of companies, and to be clear, a lot of the S&P 500 is insulated from a lot of these moves. The so-called maturity wall for investment grade companies, for high yield companies, has been pushed out. And so the immediacy of your financing needs are relatively speaking, at least relative to history, quite low. But a 5% rate is obviously a problem in a number of ways. Just look at the performance of some of the consumer finance companies, Capital One, et cetera, et cetera. So I don't want to say the level is not a problem, but at the same time, if we can just level out, even at 5%, which is a relatively speaking a high level, I think we can digest that. And at least in the short term, the equity market can put together something resembling a rally.
It's a good point that you can adjust to almost anything. It's the rate of change that is particularly painful. But you made
I just want to say, we don't know each other very well. I only make good points.
Only make good points. Well, you brought up a really interesting one that I've been kind of interested in. When you think about the S&P 500 being insulated from those higher rates, at least from a refinancing perspective, how does that logic apply to smaller companies and small cap indexes in particular?
Well, certainly, but you've seen the same thing in let's just say the Russell 2000, for instance, where the maturity wall has been pushed out. And let me be clear for the viewers, like the maturity wall is never really a problem. Companies have to address those maturities somewhere around 12 to 18 months, or usually address those maturities somewhere around 12 to 18 months in advance. So it's not as if a refinancing need arises in a week and all of a sudden we're struggling to deal with the maturity. But certainly small caps are more at risk from an over-leveraged standpoint. Those companies tend to be more lowly rated, and so the leverage issue is much more of an issue there. But you see it again in the performance of the Russell 2000. If we throw up a chart, basically at its low, whereas the S&P 500, even after an 8% decline, is still relatively closer to its high than it is to its lows.
I'm going to make a joke that I've made before, but I feel like the maturity wall is like the debt ceiling, in that it's always kind of okay.
Sure.
You know, it always works out in the end. But talk to us a little bit.
It was just as funny the first time around, too.
I mean, there's humor in there, and it's a special type of humor, and we get it. But
it appeals to a very specific audience.
Listen, my firm is watching, and they're all laughing right now, believe me.
I'm sure they are. But talk to us a little bit about the environment that we're heading into in earnings season. When you think about the market backdrop, there's a great stat from Bloomberg Intelligence that the companies that miss on profits are seeing the worst one-day reactions in several years. How high is the bar right now? I
mean, the bar is clearly very high. It is not a healthy trading environment right now, which is why really when Romaine asked earlier about what matters right now, we've got to get to that Fed meeting. And I don't imagine that we're going to get much different from what we already know, those of us that follow this very closely. I don't think there's going to be any new information per se, but we at least need to get over that hurdle. And in conjunction with that, you'll start entering a seasonally strong period for the market. And I think you can lay the groundwork for a rally thereafter into year end. But again, I just want to emphasize, I don't think any shockingly new information is going to come out of the Fed next week. They're obviously incredibly data dependent, perhaps too data dependent, and that's a worthwhile conversation to have. Yeah. But the economy seems to be holding up very well, even under the 5% interest rates that we talked about earlier. And while over time that will begin to erode economic performance, at least in the short term, it's been surprising, obviously, to everybody how well we've done.
It's interesting, too. I mean, I know that generally speaking, politics and geopolitics don't always have a direct correlation to market moves, certainly not on a longer term basis. We know there are some short-term knee-jerk reactions. But we are kind of in a weird conflux of events right now. Obviously, what's going on in Israel, in the Middle East, and then here in the U.S., where we can't even get our own House of Representatives in order. At what point does that become an issue for you in terms of how you view the market and how you allocate?
Well, listen, Solus we're long-term investors. I mean, we own some names for 10 years. So to say the least, the speakership battle is not particularly factoring into the investment debate. But in the short term, to your point, it is at times concerning. And the debt ceiling in 2011 is your most egregious example. But listen, there are all these geopolitical problems. There's domestic problems. We have the budget debate forthcoming in just a little bit of time, and we don't have a Speaker of the House. And for anyone who doesn't know, you can't do anything in the House until you have a Speaker. Yeah. So we're sort of deadlocked here. So, excuse me, do I think that part of the move in rates is related to this? I think probably yes. I mean, certainly much more important is the supply story, is the Bank of Japan, is any number of the strength of the economy and the resilience of inflation in the last 2 or 3 prints. But do I think that dysfunction, for lack of a better word, in Washington is a component of this? Sure, I would agree with that.
All right, Dan. Great to catch up with you here. Dan Greenhaus over at Solus Alternative Asset Management, helping us to kick us off to the close here on this Tuesday afternoon. In just a bit, we're going to talk about Bitcoin. Paring its gains just a little bit, but at one point, it was above that 35,000 level. We're going to talk about what's actually pushing cryptocurrencies higher.
Plus, we'll get a preview of earnings coming from Alphabet after the bell. We'll do that with James Lee, senior U.S. and China internet analyst over at Mizuho Americas.
And more insight on economic conditions. Betsey Stevenson, former U.S. Labor Department chief economist, going to be joining us just a little bit later. Stick around. A lot more coming up here on The Close on Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
We're going to see higher interest rates for longer.
You have a political, you have a monetary, you have a conflict type of environment.
We're sitting here with the backdrop, which I think we all acknowledge, of the aftermath of the terrorist attack in Israel and the events that have been unfolding since, and it's desperately sad.
Long term, I'm certainly optimistic, but I'm uncertain right now.
I'm generally an optimist. I think you'd be foolish not to look at some of these things taking place today in Ukraine, Middle East.
We will not see a hard or a soft landing in 2024.
There is the potential for persistent high interest rates and high inflation in Europe.
If you take the time horizon, the monetary policies that we're going to see and so on will have greater effects on the world. And you look at the world gaps, so it's difficult to be optimistic on that.
All right, a number of the top Wall Street bankers speaking a little bit earlier at the Davos in the Desert, the Future Investment Initiative out in Riyadh, Saudi Arabia, and outlining the uncertainty of the current economic and investing environment. And of course, trying to get a read on that environment requires a certain level of expertise. Institutional and investor are handing out its latest picks for some of the best analysts on strategists on Wall Street. And Morgan Stanley, Mike Wilson, topping the list as the best portfolio strategist. That's despite the fact that his bearish call on U.S. stocks has yet to pan out. Bloomberg cross-asset reporter Emily Greifeld joining us now for a little bit more on this. And look, we should just get this out of the way. This is really just about bragging rights here. You get to, I guess, put that on your LinkedIn page or your resume or something. I don't know if employers really care. But when we look at the names at the top, most of those names have been relatively accurate in their calls. Maybe not to the same precision of getting the number right in a certain time frame, but the overall calls that Mike Wilson has made this year have largely been on point, even though his price targets may have been off.
Yeah, his price target is pretty low. And also, if you think about last year, he was very bearish last year, and he was one of the only bears, and that forecast proved to be pretty accurate. When you look at some of the other forecasters on the list, that one we had Ed Hyman of Evercore. He took top economists for the 43rd time in the 52-year stretch of this history. But it's tough to make forecasts on Wall Street. A lot of time, your macro forecast can be right, but sometimes the investing implications are not right, or the timing isn't right yet. And Mike Wilson's still holding out hope that we will see an earnings decline, that we will see stocks dropping.
And can you just set the scene for us? I mean, we joke about it, but why is this survey important? If we're, sitting inside one of these big investment banks, I would imagine they care pretty deeply.
Yeah, they do care. Maybe more than, just putting it on your LinkedIn, Romaine. I mean, it has been around for 52 years.
Yeah, okay.
It is the most widely watched survey of sell-side analysts, and often it is used for promotions and bonuses. And of course, it always looks good to be number one when your job is literally making forecasts.
Yeah, I mean, look, right. I mean, it's a tough job, Katie Greifeld. And let's get to this idea. I mean, once you get past, Mike Wilson at the top here, I mean, obviously, we talk about a lot of other folks here who maybe have been a little bit more accurate. How exactly are they sort of picking the best or the top ranking here if it's not based solely on accuracy?
I think it's a little bit of a black box. I mean, it is based on voting. So
it's a survey. I get that.
It's a survey. I do have a lot of sources. Like when you read analyst notes, they'll say, please vote for me in this survey. So perhaps it's a little bit of whoever can get the most people to rally behind them and vote for them. Yeah, it's not necessarily always tied to who truly made the best forecast. If we go back to Mike Wilson, again, not to rat on him too much because he did have a good call last year, his price target now is 3,900 for the end of the year, S&P 500. It's one of the lowest on the street.
Okay, well, the way this market's been performing the last couple of weeks,
right,
I don't know.
It's only
we
an
might
8% decline.
It's still 2 months
we
to go.
might get there, right.
Well, talk to us. I mean, we know where Mike Wilson stands, but where's the rest of the street right now?
So the average price target right now, and this is according to Bloomberg's Lu Wang, she compiles all of these on the terminal, 43.70 is the average. We still have some bulls out there. John Stoltzfus of Oppenheimer is one of them, and he was very bullish last year. It didn't work out as well. This year, his call that economic growth will be stronger than expected has actually proved correct, but he has the most bullish target with 4,900. On the lowest side, actually Piper Sandler with 3,700, which again, maybe it'll happen. We still have 2 more months left to go.
Katie, I've always seen these requests to participate in these, and I just always ignore them. I didn't know that this was critical to their jobs.
Apparently it is. I don't know. It's like
next year
begging my family to please open my articles. You got to actually click the link, and that'll do it.
Get that hit count up, right?
Exactly. Emily, great stuff, great reporting as always. Our thanks to Emily Griffeo of Bloomberg. And I mean, it's not just equity strategists too. It's the same for the bond guys. They all have to compete. It is a popularity contest. It feels like at the end of the day. So high school never ends.
High school never ends. I do wonder, internally though, what the debate is, because I mean, feel like these price targets, and even Lori Calvasino was on with us yesterday on the close, and she kind of even joked about her own price target, saying that, look, they basically put a gun to your head and say, pick a number, and she's kind of like, look, these numbers are fluid, but it's an explanation. If you ever sort of read Mike Wilson's notes, for example, or listen to his little podcast that he puts out, you get that explanation behind the number, and then it starts to make sense.
Exactly. Context is needed. The numbers are fluid. But in any case,
what's your call for the year?
Blissfully, I don't have to make one. I just get to talk. Coming up, though, on the close, China's president makes some big moves to boost the world's second largest economy. We're going to get into the details next. This is The Close on Bloomberg.
Chinese President Xi Jinping is stepping up support for his economy, the second biggest in the world. In addition to issuing additional sovereign debt, raising the budget deficit ratio, and even making an unprecedented visit to the central bank here, it's causing a lot of speculation here as to what the policy changes could potentially be going forward. Bloomberg Economics chief economist Tom Orlik joining us right now to talk a little bit more about this. And let's talk about, I guess, the one trip that I think everybody is obsessing about, and that's him physically going down to the PBOC, the central bank there, which I'm told is the first time that he's done that in his official capacity as leader of this country here. Why is that significant in and of itself?
So I think the thing which has kind of concerned the markets about Xi Jinping, Romaine, is that in contrast to China's previous leaders, in contrast to Deng Xiaoping, Jiang Zemin, Hu Jintao, Xi's focus has very much been on national security. So this trip to visit the People's Bank of China, China's central bank, seen as the kind of the champions of China's pro-market financial reforms over the last few decades. Well, the hope here is that this is a signal that Xi Jinping does actually take the economy seriously, does actually take reform seriously, and so potentially will be lining up policies in that direction going forwards.
I know we have no idea exactly what he said or what sort of guidance maybe comes out of this here. But when you couple that with the news that the legislature approved a plan to raise the fiscal deficit ratio by about 0.8 of a percentage point here, pretty significant to go from 3% to 3.8%. This, at least to me, screams stimulus.
Yeah, it's not the shock and awe stimulus that perhaps we would have expected from China in the past. But if you take the symbolism of that trip to the People's Bank of China and the substance of that trillion yuan boost to the fiscal spending, the signal, the combined message there really is unmistakable. And it's interesting, Romaine, we haven't had that kind of big bang stimulus in China that we've had in past downturns. But if you add up the kind of steady drip of stimulus that we've had from the PBOC with cuts to its reserve requirement ratio, a medium-term lending facility, and yuan depreciation, and you add on this move on fiscal policy, you're actually getting to some pretty significant aggregate numbers. When we put the numbers together, we see a boost peaking in the middle of 2024 with around a 2 to 3 percentage point boost to GDP growth. So it's come incrementally, so it hasn't really fired the attention of the markets. But especially with this latest move, it's now starting to add up and look like a pretty significant offset to the drag from China's slumping property sector.
And Tom, to that point, maybe it's not shock and awe necessarily, but when you add up the cumulative effects there, is that enough to change the direction of the ship when it comes to the economy?
So I think the important thing to keep in mind, Katie, is that there's two things going on here, right? On the one hand, you've got stimulus, which is starting to add up to something pretty significant. On the other hand, you've got the giant sucking sound from the kind of slow motion cratering of China's property sector. And that, unfortunately, is a process with some distance still to run. So when you put these two things together, I think the hope is that China next year will manage to eke out continued steady growth, perhaps something close to that 5% mark, which they set as target for this year. But we're certainly not looking at anything which looks like a return to the boom times.
And Tom, we don't have too much time left, but when you think about what's still left to do, some still big concerns out there as related to the property sector, but even still this kind of consistent stimulus coming from Beijing, do you think that's enough to give foreign investors the confidence that they need to come into China?
So I think this meeting, this visit of Xi Jinping to the People's Bank of China, it's intriguing, right? As Romaine said, we don't know what was discussed there, but I think what we will see in the weeks and months ahead is if there's any substance behind it, right? The People's Bank of China were really the champions of financial market reform and opening in China. Interest rate liberalization, yuan liberalization, opening the bond and the equity market to foreign investors. That was all the PBOC. For the last few years, they've been quiet. Let's see if they get back on track.
Tom, always great to talk to you. Bloomberg Economics chief economist Tom Orlik there. A closer look here at the state of the Chinese economy and maybe some of the efforts that Xi Jinping and the legislature there is making to provide a bit of stimulus. Stick with us. We'll be back in a moment with the close on Bloomberg. This is the countdown to the close of equity markets right now, continuing to push a little bit higher here on the day. A little bit of a tepid day in the Treasury space. Let's get a look at what's happening in commodities right now with Abigail Doolittle, who's standing by with our commodities close.
Well, not so much for commodities, Romaine. Stocks may be higher, but we have commodities down for another day in a row. Yesterday down close to 2%. Today being dragged down again by a third down day for New York crude, now down about 5% over the last 3 days. Having a lot to do with as Israel oil is rethinking its ground invasions. Traders thinking that there might not be as much of a supply crisis as it's unclear as the war remains contained, at least right now. Similar deal for European gas futures, down 3.9% after surging initially so much related to some supply coming out of that area. Wheat down 1.5% and corn down 1.4% as rains boost the Brazilian crop outlook and therefore supply. As for oil, we've been talking over the last week about the possibility of a big directional move. It seems like we're getting closer, and if we go into the Bloomberg terminal, we will see that oil is perhaps on the cusp of making a big move to the downside. It is back below its 50-day moving average, as you can see here. Here's the uptrend that we've been tracking more recently, a 20% move up here, a roughly 10%, actually 15% move down, up, down, right now about down 10%. This here, Romaine, that's a bearish area of congestion. It tells you that the sellers are really thinking hard about pounding the buyers, that the buyers have less reason to buy. If this continues to break down in this manner, we'll probably go not just below 80, but we could go all the way back down towards 70. So the volatility that we've seen in oil all year long, well, it looks like it may just continue.
All right, our thanks there to Abigail Doolittle here. A look at the commodity space. Let's now turn to, well, something that's actually been pretty active as of late, and that is what we've been seeing in crypto. Bitcoin retreating from its 18-month high. It broke above 35,000 a little bit earlier today and has been on a pretty impressive run over the last few days, fueled by expectations that we could finally see a U.S. spot Bitcoin ETF sometime soon. Of course, all of this comes around the trial of Sam Bankman-Fried here in Manhattan and the release tomorrow night of Ruin, the fall of the crypto exchange FTX documentary produced by Bloomberg. Pleased to say that Bloomberg Business Week columnist Max Chafkin joining us right now, who helped to work on that upcoming documentary. Max, great to have you here. Very timely that you're going to release this just as you get a nice big rally in Bitcoin. Everyone's paying attention to crypto again.
Yeah, it's great timing. Yeah. I mean, as you said, this ETF thing has, I think, long been the dream of crypto bulls. You know, the idea that normal people would put this in their sort of normal bucket of investments alongside other ETFs, that's a thing that, you know, if you're interested in this as an investment vehicle is very important, and that all of these crypto companies have been pushing to for years. So the idea that it could happen, and it could happen in the near term, you know, of course, is going to send the price up.
Yeah, I mean, a spot Bitcoin ETF in the U.S. has been the white whale for a while, especially for some of these issuers. But the question I keep asking is how much demand is there left from normal people? Because you reflect on a year since the collapse of FTX. I imagine that wiped out a lot of interest from the retail crowd, from the normal people.
I was going to say, yeah, I think we should resist the urge to read too much into these price movements because, again, we're not seeing the volumes of crypto transaction that we once saw, and of course, Bitcoin and all cryptocurrencies are really, you know, vulnerable to emotional swings and so on. So I don't think this shows that people are definitely ready for this. It's more that this could become a thing. Yeah. And as you said, there have been lots and lots of reasons to question whether this is something that really belongs in the, you know, portfolio of a normal investor, someone who's like, you know, most of their money is in a 401k. Yeah. And starting with the fact that we've seen these crazy swings over the last few days, some of which are based on rumors and so on.
But that kind of brings us back to the documentary Ruin, which is being released. I mean, we're almost on the one-year anniversary of when we first kind of learned about the collapse of FTX and now the trial of Sam Bankman-Fried. And there's been a lot of discussion about how that was a big inflection point for shaking out, as Katie said, the normal people. And even some of the Bitcoin faithful, the crypto faithful, who kind of decided that maybe this was all a house of cards here.
Yeah, just absolutely devastating, I think, to the crypto movement, partly because Sam Bankman-Fried's whole pitch was that he was the friendly, law-abiding, you know, politically connected face of an industry that, you know, otherwise had been seen as kind of sketchy. Now, of course, it's not great when the guy who's promoting himself as sort of, you know, the upright one turns out to be accused of a massive, you know, multi-billion-dollar fraud. And again, I don't think we quite know how people are going to feel about crypto going forward until we get a sense of the verdict in this case.
Max, it's great to check in with you. That is Bloomberg's Max Chafkin. And of course, you can watch that Bloomberg original documentary called Ruin, the Sam Bankman-Fried story. It's going to premiere on October 26th at 6 p.m. Eastern Time right here on Bloomberg Television. Still ahead on the close, though, we're going to get a preview on what to expect from Alphabet when Google's parent company reports after the closing bell. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with PVH, the apparel company behind Calvin Klein and Tommy Hilfiger, getting a lift to overweight over at JP Morgan, with the analysts saying the company's actually doing a better job on generating more consumer interest for these more mature brands, a strategy that can set the foundation for what he calls a multi-year brand unlock. Shares higher by about 3% on the day. Next up, let's take a look at DraftKings, getting an upgrade to buy over at MoffettNathanson, with the analyst saying the sports betting company has a story that is, quote, stronger than ever due to a focus on managing expenses. Yeah, the year of efficiency. Couple that with robust sales growth, and DraftKings is on the cusp of a meaningful inflection in profitability, so says the analyst. Investors say bid it up by 4%. And finally, let's take a look at Alphabet. Seaport Research starting coverage of about 10 internet companies. Buy ratings being handed out to a lot of them, including Amazon, Pinterest, and Meta, but not for Alphabet. It got a neutral rating, with the analyst saying that while he's constructive on the longer-term growth of that sector, he still has some macro concerns, as well as concerns here about geopolitical tensions that could be a factor here in that ad business. Shares, though, bucking the trend, up about 2% here on the day. Of course, Alphabet does report quarterly results after the closing bell tonight. Full coverage right here on Bloomberg. The company expected to show net revenue gain 10% to about $63 billion from a year earlier. Now, that would be the fastest pace of growth in 5 quarters. The company benefiting from a recovery in that digital ad market. James Lee joining us right now, senior U.S. and China internet strategist over at Mizuho Americas. He has a buy rating on Alphabet. And James, let's get some insights here. Let's start with the ad business here. I would think that Google, Alphabet, if you will, is a little bit more insulated from any sort of doldrums we might be seeing in the ad market relative to its peers.
Hi, Romaine. Good to be on your show. I think your assessment is generally correct. If you look at Alphabet's advertising exposure, is very broad-based. It's a combination of products. If you think about e-commerce, and also services, if you think about travel, if you think about restaurants, dining, and also entertainment, because this broad base of revenue, that allowed the company to be very resilient, based on this shift in terms of spending. Obviously, in the first half of the year, we saw a lot of mix shift from products into services, especially into travel. And that's why Amazon has a decent exposure in travel advertising revenue. And that's why into the quarter, I think the company will do very well in terms of advertising revenue, whether you look at search or you look at YouTube.
And when you think about the ad spend, when it comes to Alphabet, of course, there's been a lot of concerns over the past year or so about ad spend as it relates primarily to social media companies. Is the type of ad spend when we're talking about with Alphabet a little bit more insulated from some of those headwinds?
Oh, yeah, no doubt, right? If you look at recently, especially looking at the current quarter, we saw consumer spending in general, Katie, still remaining pretty resilient, that being first. And also, secondly, if you look at Prime Day, which is the promotion for the entire e-commerce industry, and the industry did relatively well, which is a positive indication for search revenue. And also keep in mind, Alphabet does not have a natural competitor when we think about search in general. So obviously, they're going to do very well because of those factors that was just laid out earlier.
Of course, this was a company that I think used to get like 99% of their revenue from that ad business. That's now down into the 80 percentile range here. Of course, with the cloud business, that cloud computing business really starting to come up here. We're talking about 10% of revenue, at least in the last quarter here, James, and a relatively profitable business right now as it stands.
Yeah, I think the cloud business may be a little bit choppy in the near term because macro concern. A lot of enterprises are a little bit more cautious on spending in general. But when I look at Alphabet's position, Romaine, in terms of AI, its strength is very strong. The platform has the largest portfolio, the large language model to meet market demand. And it also has industry-specific solutions to penetrate into deep verticals such as healthcare, and also has a best-in-class analytics to actually turn large language models into useful applications. So overall, We think these are positive drivers in terms of adoption of Gen AI. And certainly we think Alphabet, in terms of cloud computing, is front end of that technology curve.
Talk to us a little bit about Amazon, too, because Amazon takes the stage on Thursday. I'm looking through your notes. You say that Amazon is the top pick into the quarter. What are you expecting to hear from the company?
Yeah, Katie, good point. I think the buy-side expectation is too negative this quarter. A lot of buy-siders or investors are pointing to some of the third-party tracking, which look for deceleration this quarter. We did a very deep channel check with channel partners, which indicating that the quarter is actually stable. So I think the setup is actually similar to last quarter where the bar is pretty low. I think all the company has to do is stay that cloud computing business remaining pretty stable in the back half. I think the stock will do well on back of that comment.
All right, James, great to catch up with you. James Lee there over at Mizuho. A closer look here at least one of the big earnings that we're going to get after the bell tonight, Katie Greifeld. That, of course, comes from Alphabet, not just an ad story, but obviously the cloud computing story as well. We're going to get Microsoft, too, which should give us a read also on corporate IT spending.
Yeah, a lot to look forward to this week when you think about just the heft of these companies that are taking the stage. And it'll be interesting whether they can change the narrative around the stock prices, because a lot of these companies, they're still sitting on double-digit gains for the year, but we know those gains have really stalled over the last couple months.
Absolutely. Definitely a closer look at valuations, and maybe that's why you're seeing some of these companies talk a lot more about cutting costs and profitability. Coming up here on the program, we're going to talk a little bit more about the economy and the job market, a job market that has been defying the odds. Betsey Stevenson over at the University of Michigan going to be joining us to make sense of how the Fed can deliver on its mandate to cut inflation in a tight labor market. That conversation coming up in our Wall Street Week Daily segment right here on The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day at this time. A focus today, David, on the economy and specifically the labor market and sort of this needle that the Fed has been trying to thread here in fighting inflation at the same time, not completely destroying the labor market.
And you just said it, Romaine. It's been a little bit of a puzzle for a lot of people why the labor market has been this strong, this long, despite all the rate increases. So to get some answers, we thought we'd turn to Betsey Stevenson. She's professor of public policy and economics at the University of Michigan. She was at one point the chief economist for the Department of Labor. So, Professor, thank you so much for joining us. We talked with Jay Powell, the chair of the Fed, last week, and he said there are indications now that the labor market may well be softening, or as he put it, coming into balance. Do you see those indications?
Oh, there's certainly signs that things are settling down in the labor market. I mean, we've seen really unprecedented amount of job changing with, a quits rate that just spiked, coming out of the pandemic, and a lot of dynamism in the labor market. Lots of people changing jobs, re-entering the labor market, entering the labor market, just a lot of movement. And for sure, we're seeing that movement dying down. Whether that means the labor market will be less tight or there'll be less slack in the labor market, I think is yet to be seen.
So, Betsey, why do you think, as an economist, why do you think that we all got it so wrong with the labor market? We got it wrong. The Fed got it wrong about inflation for a while. They thought it was transitory. Now it looks like the labor market's a lot stronger than we thought. What is it that's going on?
Well, people don't always behave the way we think they're going to behave in our models. I mean, that's really what it comes down to. And we saw some really unusual behavior coming out of this pandemic. The Fed just released their survey of consumer finances a few days ago. And what they showed was 1 in 5 households is now the owner of some kind of private business. Half of those are self-employed businesses, but the other half, these people have employees. If you compare that to 2019, only 13% of households had some kind of business, and it was roughly a similar share had employees. So there's a lot of people who started businesses and they hired people. So we've just seen real spirit of entrepreneurship step in to meet the supply challenges that were, meaning that people couldn't buy the stuff they wanted to buy. American ingenuity came in and said, well, if no one else is going to start that business, I'm going to start that business, and then I'm going to hire some people. We don't usually see that kind of behavior coming out of a recession.
Yeah.
I think personally, if you ask me what's at the heart of it, it's the massive government support that also meant that we saw the largest 3-year gain in net wealth in American households between 2019 and 2022 on record by quite a lot. So you give people financial security and you give them a lot of economic desires in the economy to fulfill. And what you see is people start businesses and they hire people, and supply expands a lot faster than any of our models expected.
Do you think, though, that's going to last? Do you think that's going to stick? And I ask that question because a lot of the government support that you talked about, as I'm sure you know, has either been expired or pulled off the table in one way or another, or is under threat of being pulled off the table.
Well, we actually don't want to see the sort of growth that we've seen over the last couple of years, because some of that was recovery. But what we want to see is that it sticks. We want to see that in 3 years, we see just as many households have businesses. I don't think we want to see the growth rate stick. The growth rate's almost unsustainable. It was so large. Are we in a new spirit, a new period where American businesses are more dynamic? I think that is somewhat of an open question, but I don't see any signs of it reversing. Yeah. And I think that's what's really important, is we've seen the Fed be able to bring inflation down without unemployment going up. And they've been able to do that because I believe supply has expanded, both labor supply and business supply.
I'm curious, though, when the Fed finally does get to the end of this cycle, there is still a debate that has to be had about just how inflationary the labor market was or could have been if left unchecked. And it raises the question is that if some of the job growth and the job gains we got were sort of constructive, meaning small businesses, entrepreneurship, things like that have a material impact on GDP growth here, isn't that something that should be, I guess, nurtured and encouraged, not only by the policymakers in Congress or the White House, but to a certain extent the Fed as well?
I completely agree. Long before we had this pandemic, there was a lot of people that were questioning just how useful is it to look at the unemployment rate as a gauge for setting monetary policy and predicting where inflation is going. The Phillips curve had completely flattened prior to the pandemic. It looks like it's steepened a bit now, but people are saying that looking at 6 quarters worth of data. Who knows what they'll say 6 quarters from now? I think what was important to realize is that if unemployment had been rising over the last 2 years, in some sense, it would have been self-defeating. Look, the reason we saw the price of hotel rooms going up was not because we didn't have hotels, but because they didn't have staff that was necessary to be able to to fill all those hotel rooms with the customers who wanted to be in them. If you ended up telling them to hire fewer people, that's certainly not going to solve the problem, right? In that sense, it's self-defeating. So I think the Fed took a slow and steady approach, which has given them that soft landing, because what it's allowed to happen is labor supply to come back. And we've definitely seen it come back. I do think there are open questions now about how much higher can the labor force participation rate grow? I think anybody tells you knows the answer to that is not being humble, because if you look over the last few years, most people's predictions were wrong.
Betsey, let me ask you maybe the ultimate question, which is, can we get down to or near that 2% inflation number if the unemployment rate is still 4 to 4.5? Can we keep unemployment that low and still get to 2% inflation?
I absolutely think we can. I do think that it's always the last mile that's the hardest, and I think we're going to have to ask really tough questions about how quickly we get there, and what we need, what we're willing to sacrifice in order to get there. But I don't think that laying a bunch of people off is going to ultimately solve the problem. We haven't seen inflation really being driven by wage demands so far. What it's been driven by is consumer demands for things that can't be supplied by the market.
But Betsey,
the Fed's got one tool, which is reduced demand. But there are other solutions, increased supply.
Betsey, when you talk about wage demands, I'm mindful of you being in Michigan, where the UAW is in talks right now with the automakers. Is that a fundamental shift you're thinking in the labor market, or is it just a one-off?
I think what's happening with the unions is they're looking forward and realizing that they're really in the fight of their lives. We saw the unionization rate hit an all-time record low in 2022. they've got the sense they've got the wind at their back is the public is really supporting unions. They want unions to exist. If you look at the things that they are fighting for, the UAW, one of the things they're fighting for is to make sure that electric vehicle plants have unionized workers. If they don't fight for that, they're not going to be around to fight for anything in 5 or 10 years. They're fighting to try to reduce the length of the work week. One of that's about making sure that there are more people employed, even as technology starts to crowd out people's jobs. So they're thinking ahead and saying, I know how to preserve jobs. We could all work a shorter week. So I think that they're not making a grab that's based on having a lot of bargaining power. I think they're making a grab based on the fact that it is really do it. It's now or never. They've got to fight right now in order to preserve unions so that unions will keep playing a role in the economy.
Betsey, always great to talk to you. It's Betsey Stevenson of the University of Michigan. And Romaine, on Friday, we're going to talk to Roger Altman. It's about how all of this is affecting the rates and the inflation and, by the way, geopolitics and Washington. We're going to talk to him. That's coming up at 6 p.m. Eastern Time on Wall Street Week.
And you can catch David Weston every day at this time on The Close here for our Wall Street Week daily segment as we head into the final hour of trading here on this Tuesday afternoon. Green across the screen for equity markets with the yield space tamped down for just a bit. But, of course, we get the big heavyweights reporting after the bell tonight. Earnings out of Microsoft, Texas Instruments, Visa, as well as Alphabet could have major market implications. Stick with us. This is Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
Katie, it's a green on the screen. I think most people will take it here, but fractional gains to be sure. But coming off some of the just gyrations that we saw, what am I trying to say? Volatility that we've seen over the past few days. I think some people will take this, but this might be the lull before the storm because we've got some big earnings coming after the bell.
We've got some big earnings, of course, and we'll see how that changes the narrative. But it is kind of nice to just rest and look at all the green on the screen that you mentioned because it's really across the board. It feels like we haven't seen that in a while. You have stocks up, the S&P 500 extending gains. It probably helps that it's a pretty quiet day in the bond market. I mean, 1 basis point lower on yields. It's pretty much unchanged when you consider the volatility that we've had. Yeah, a pickup in the dollar here on the day and a big pickup in Bitcoin. In fact, at a 7% gain here, at least based on Bloomberg pricing. That would be the best day that this is that we've seen there going back to, I believe, mid-March here. I'll flip up the board here because I do want to talk a little bit more about earnings and really the next catalyst for this market. Typically, whenever you have these earnings seasons, particularly when it comes to the big heavyweight companies, this is also accompanied by these sort of big buyback announcements that provides a boost to those individual stocks, but of course to the broader market. What this chart is showing you, and the yellow line on the screen there, this is an index that tracks the companies, the 100 companies with the biggest buyback plans. And you can see, relative to the blue line, the S&P 500, there's been huge underperformance there. And a big part of the reason is, quite frankly, there haven't been as many buybacks. Yeah, that's the thing. And it's fascinating to see that chart because you're still seeing the reaction when a company announces a buyback in the shares. That actually leads in really nicely to some of the movers I want to talk about. Let's talk about RTX first. I had put it at the bottom, but we'll rip up the script because RTX, it's soaring today. Of course, it helps that it announced a $10 billion buyback. Of course, it's trying to contain fallout. It had that quality lapse when it came to one of its big engines for commercial aircrafts. But it's buying back shares, and shareholders seem to like it, up 7%. So you're still getting the one-day reaction. Let's go back to the top, though. I want to talk about GM. GM reported earnings. It actually was a pretty okay
the earnings
quarter.
Were decent.
Yeah, it was a good quarter.
It was the forecast
for GM. That's the thing. Yeah. They withdrew guidance, of course, as strikes continue. They said basically we can't tell you what full year profit might be because we don't know. We do know, though, what it's meant for the company so far. They said that strike costs so far have reached about $800 million for GM, and that going forward, it's going to be about $200 million a week. Yeah, and we're going to talk a little bit later in the hour about the latest on the strikes. Yeah, so we'll see there. And let's also talk about Verizon, of course, keeping it on earnings. Verizon having a great day, rising by the most since 2020 at one point. It beat on profit. It upped its guidance, so a beat and raise quarter, even though you are seeing continued decline among its mobile consumers. That's more than offset by what you're seeing in the internet business phone results.
I'm very fascinated by this because remember a couple of days ago we saw that big rally in AT&T and some of these kind of old kind of telecom companies seem to be showing some degree of life here as they try to make a bit of a transition away from that old economy business. Meanwhile, we are making the transition to the final hour of trading. Our coverage starts right now.
Down to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovec. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and our partnership with YouTube here. Carol, it's great to have you here in New York City. I'm wondering why you're not over in Riyadh, Saudi Arabia, because I'm told that's where all the action is happening right now with the Davos in the desert. Who coined that term?
The Davos in the desert. Listen, I would so want to be there. I feel like it's among the most read stories on the Bloomberg today, so terminal users are really tapping into it. But I feel like it's financial titans, the voices we care about. Among them, first and foremost, Jamie Dimon, who was kind of coming in hot when it comes to central bankers. Here's part of what he had to say.
I think it makes a piece of difference whether rates go up 25 basis points or more. Like zero, none, nada. I think whether the whole curve goes up 100 basis points, I urge people, be prepared for it.
He doesn't know what's going to happen, and he was pretty critical of basically central bankers not knowing 18 months ago what was going to happen. And I think he makes the point that, we live, Tim, on every word that we hear from central bankers, or certainly here in the United States, Fed officials, and yet Jamie Dimon reminds us that they didn't really get it right.
But what is coming? I mean, and what does this time period remind him of? Well, he said it's kind of like the 1970s with high spending and lots of wastage, but he did brush off the impacts, as you heard just now, of further rate hikes, Katie. So, not a weather report from Jamie Dimon, but certainly fighting words for those policymakers.
Fighting words for policymakers. Hating on the Fed, it seems to be a unifying force, but it wasn't just Jamie Dimon with some harsh words. I do too. But in any case, we also heard from Blackstone CEO Steve Schwarzman talking about remote workers. This was pretty interesting. Take a listen.
People got used to, staying at home. And it was actually more profitable for them to stay at home because, one, they didn't work as hard, regardless of what they tell you. And the second is they don't spend money to commute.
So some harsh words for remote workers. And I mean, we've heard
says the guy
other
who
big
owns
CEOs.
a lot of office real estate or real estate in general.
Exactly. I mean, we've heard other big property owners and other big CEOs sort of trot out that narrative that they want people back in the office because they're not as productive as home. I don't know if the data necessarily backs that up.
Because he started off the comment, it made sense, right? People are saving money because they don't have to pay for transportation and dry cleaning and a lot of the things they would do. But the idea that somehow they're not working as hard.
Yeah.
I
mean, this is
Katie,
come
were
on.
you productive when you were home?
Yes.
Romaine, were you even home, Romaine?
No,
yeah.
No, I'm the hardest working man here. I never left.
Tim, you were here.
I wasn't even home at all.
I worked from home. I was really productive. I got to tell you, my workday kind of never ended. But I get the point of being in the office, but come on.
Yeah.
I just hate the generalization of comments. I mean, I'm sure there's a crop of workers out there that his comment applies to, and I'm sure there's some nuance to that comment that we're probably missing by just playing that one little clip. But we've heard this narrative before, this idea here that somehow this is going to just be so disruptive to our economy, and maybe we just need to embrace the idea that this is our economy now. So you know what? Man up.
I think that's right. I mean, but there's no one size fits all approach. I mean, maybe for Blackstone, 5 days a week for exexecutives and 5 days a week for workers is what works for the company.
What happened to
I know a lot of Blackstone executives. They weren't in office 5 days a week before the pandemic.
What happened to everybody saying how great
Not
this
a
is?
chance.
They were not in the office, you're saying?
No, 5 days a week.
You got to play the golf a little bit. You got to get the deals done. You got to go where the deals are.
I'm just
you got to go to
say,
Saudi Arabia.
Shut up, you guys. I'm just going to say, what happened to the idea of flexible working, bringing people into the workforce, making it easier for women, and then that would lead to greater productivity all around, more people in the workforce.
Good point. I'm glad you interrupted
I'm sorry I
us
said
for
shut
that,
up.
Carol.
That's not a nice thing. But I believe in the man up part.
So you're like one of like 12
I'm
kids.
from a large, you kind of had to be heard. You had to be heard. It wasn't easy. All right, guys, stick around. We got a lot coming in less than an hour's time. We've got some big earnings report, Microsoft, Alphabet.
Can I talk yet?
What?
Can I talk yet?
No. It's Katie and my floor right now.
All right,
we'll see you in less than an hour's time. Our cross-platform, radio, TV, YouTube, and Bloomberg Originals. Join us for Beyond the Bell.
We continue our markets coverage right here on The Close, Bloomberg Television, counting you down to those bells. We just got about 50 minutes or so to go before we get to them. Let's get some insights out of our next guest. Eva Ados joining us right now, the COO and Chief Investment Officer over at Entrepreneurshares. And Eva, let's start off here with earnings season, because a lot of us are kind of looking to tonight and really over the next couple of days where we're really going to start to get those big cap tech names in the index finally reporting, finally showing the revenue growth, showing the profitability, and more importantly, showing whether investors are comfortable with the valuations that some of these stocks sit right now. In aggregate, what do you really want to hear out of some of these companies over the next few days and weeks?
Well, we are cautiously optimistic, and I think many companies, especially in tech and healthcare, have been proactive. They have been cutting down their SG&A costs in order to face inflationary pressures. But what's most important to us is the macroeconomic events, because up until now, up until yesterday, actually, the earnings season was quite disappointing. That's because any company-specific news were overshadowed by macroeconomic events. The Middle Eastern tensions stole the show so far. And then any negative company-specific news were magnified, just like we saw with Tesla, which dropped 15% last week. So we're continuing to remain optimistic that if the tensions in the Middle East do not go beyond the current skirmish between Hamas and Israel, we might see again, company-specific information and developments in the companies that deserve to have the attention of analysts, they'll come back in the spotlight.
To come back into the spotlight, and when we talk about the geopolitical issues, Eva, this also raises the question here just about the health of the global economy. Even before what happened in Israel a couple of weeks ago, you had an economy in Europe, in Asia, and to a certain extent in parts of Latin America that was struggling. Even here in the U.S., you can make an argument here that there's been some material softness. Do you think that the economy will hold up enough to support the fundamentals of publicly traded companies?
So up until recently, we thought that a Goldilocks scenario for 2023 and 2024 is the most possible scenario. And I think I want to be optimistic, and I continue to believe the same. However, if the Middle Eastern tensions rise and then we'll see a spike in energy costs, that will add fuel to inflationary pressures. And that comes on top of a slowdown in the U.S. economy. China's growth is slowing down. That brings down the global demand, which is important. We have seen an increase in defaults, both in corporate and subprime default rates. And so all these things are very concerning. However, on the bright side, we have unemployment, which has remained low, and we expect it to continue to remain low. And that's because of the large amounts of baby boomers who are retiring at a rate of 4.3 million a year. That's significant. And we expect to have unemployment to continue to save the day. It has been acted as a stabilizing factor, and it has kept spending high. So if we do end up seeing a recession, we expect it to be very, very mild.
Very mild recession, but I want to focus in on what you said about energy costs, energy prices. If that's the case, and we are heading into a period of sustainably higher energy costs, how do you position a portfolio around that? Because I imagine the typical playbook would be to buy energy companies.
Exactly. And I think it's very important, more important than ever, actually, to have a very adaptable investment strategy. It's more important than ever to be tracking very closely the macroeconomic events, both when it comes to the global tensions that we have and the rising treasury rates. Because, as you said, if we see the Middle Eastern tensions escalate, then it's prudent to take risk off, reduce your weights in risky assets, such as long-term assets, as well as move from smaller cap to large cap, and increase your weights in oil and other energy stocks. At the same time, on the flip side of that, if the tension continues to remain between the Hamas and Israel, then it's I think given the current pricing of the market, we might even see an end-year rally. So in that case, you need to move down from large cap to smaller cap and add exposure to healthcare and technology companies. And then I think so overall, I think it's super important to be tracking the macroeconomic events very closely on a daily basis.
And Eva, what's the haven in that environment with that sort of mix? Is it still bonds, or are you looking elsewhere for protection?
No, we are avoiding long-term bonds in particular. As interest rates rise, bond prices come down. We are actually tracking very closely our ER30 TR total return index, which is up about 40% year to date. So we continue to track this. That's very heavy in technology and healthcare and communication services. But at the same time, we are adjusting every day. We recently reduced our oil and energy positions to add back more weights into tech as we see that the tensions do not escalate between Hamas and Israel. Again, though, we need to be very cautious. There are pockets of opportunity, but you have to be very careful with the macroeconomic events that are stealing the show these days.
Still opportunity, but you have to be careful. That's a good place to end on. Eva, really appreciate your time. That is Eva Ottos of Entrepreneurshares. Now coming up, we'll get insight on investing from David Bailin, Global Head of Investments and Chief Investment Officer at Citi Global Wealth.
Plus, General Motors pulling its profit forecast for the year. That UAW strike making it too difficult to predict. The latest on the market reaction to the news.
And we'll drive to the closing bell with Sherry Paul, Private Wealth Advisor and Senior Portfolio Manager at Morgan Stanley Private Wealth Management. All that and more coming up. This is The Close on Bloomberg.
And stocks holding on to gains for the day with less than 44 minutes until we get to those closing bells. Fractional gains to be sure, but green almost across the screen with the Dow, the S&P, and the NASDAQ inching higher ahead of some big earnings coming after the bell tonight. That includes Microsoft, that includes Alphabet, that includes Texas Instruments, and that includes Visa. So far, the earnings season hasn't been awful, but there have been a few weak spots here that have caused investors some concerns. But of course, everyone looking to those big mega cap weighted names. We're talking about not just the heaviest weights in the S&P 500, but of course, two of the most profitable companies in the S&P 500, at least when it comes to Microsoft and Alphabet. As far as the Treasury space, a bit more subdued here on this day as some of the volatility that we've gotten used to appears, at least for right now, to be tamped down just a bit. Abigail Doolittle is standing by right now, as she does every day at this time, with our Options Insight segment. And Abigail, you're taking a look at what had been one of the big drivers of cross-asset volatility, and that is the Treasury market.
It really is pretty incredible, Romaine. No matter what time period you look at Treasuries in terms of the massive backup in yields that we've had over the last month, 2 months, 3 months, 2 years, it's really pretty astounding. But yesterday's volatility was pretty amazing. I think the 10-year yield started out around 4.92, then got rejected at 5%, and then at 4.85, now at 4.83. To bring more perspective on this move, Michael Purves, CEO and founder of Tallbacken Capital Advisors. Great to have you with us. And what do you make of this, especially yesterday's move? It seems like the whole curve is flattening, going back up toward where the two-year yield is. Two-year yield pulling the rest of the yield curve, but the 10-year yield 5% right back down.
Yeah, well, 5% is a big round number. You have to think that some traders may have been looking at that. Hey, if we can ring that 5% bell, maybe we'll take profits. It looks like Mr. Ackman did that yesterday there. But I think there's a broader and more interesting story beneath the surface there on what's been pushing, really driving force and pushing these back-end yields so much higher. If you look at positioning across the Treasury futures market, it has been very bearish, extremely bearish, meaning rates higher, right? And what is also interesting is that it's been this way for a long period of time. This is not just a last couple of weeks type of development. If you look at sort of net speculative positioning relative to open interest, for example, it's been at that same ratio the entire year, really. So what's happening here is that I think big hedge funds, big traders are putting on these shorts, and they're putting them on consistently, right? So let's see what the positioning data comes out this Friday to be and next week here. But, so far they have not flinched. If you look at what happened right after the immediate aftermath of the Israeli attacks, they had chances to cover. They did not, right? They're sort of saying, hey, here's a deflationary shock. Here's something to go. I better cover my short. They really did not. They kept pressing this bet. And this is why I think you can't be too complacent in thinking, oh, because we're up at 5% and rates are in a little bit, that this whole rate rise is over.
Yeah, and well, technically, from a chart technical standpoint, I can easily make the case on the 10-year yield that we're going to see most likely 580 at some point, something significantly higher. So what do you think that is in terms of, because it looks like we did have maybe a little bit of a short squeeze, but for the most part, as you're saying, the short's really staying on position. Is it that getting paid to be patient, that you can park money, in bills or bonds or whatever it is, or from the short perspective, those traders take advantage of the idea that there are traders out there doing that?
Well, look, I think there's sort of 3 or 4 pillars that the short treasury, meaning yields higher trade, sort of hangs its hat on. One of those pillars is simply that you're not really fighting the Fed here. You are kind of agreeing with,
Finally,
with the Fed, right?
Traders have not been doing that for a year and a half.
I mean, Powell's sort of saying we're edging in, we're probably looking at higher longer-term policy rates. I'm talking about 23 and 24, but over the broader term here, right? That's a massive change here. If you look at the long-run projections and the FOMC dots we get every quarter, they've been stuck at 2.5% since 2018. I actually think that's going to start inching higher here, right? And even if that goes up to 3% or 3.25%, there's long-term implications for how the Fed messages what its rate policy is probably going to be like down the road.
So let's bring in the volatility indicators, the indexes, into this conversation. So the MOVE index is really pretty much off of its highs, but we do have the VIX pulling higher, going toward 20. This as the 10-year yield is close to that 5% level. What does higher yields mean for? And why aren't we seeing more S&P 500 puts with some of those shaky technicals and bringing in rates?
Well, there's a lot to unpack there. But look, one of the really interesting things here is that, yes, the MOVE index, which is the VIX for the Treasury curve, it has been moving higher here over the last few weeks. It really was when the 10-year broke 4.5%, right? And that, to me, to your technical point, you could see 580. Well, that once you took out 4.5% decisively, it opened up a lot of real estate, if you will, on the charts. If you go back 15, 20 years on the charts, you can see there's a lot of open space there for yields to range higher. So that gets the interest of trend-following models and so forth. There. But, look, I think so Treasury volatility has been coming up higher here, but the first 2/3 of this rate rise which started in May, right? The MOVE index was actually going lower.
I know.
Right? That's what's so interesting here, right? So, and it makes sense. Last year, Treasury's yields shot up higher and the MOVE index shot up higher. Now or at least certainly the summer, it was about these slower, longer-term structural shifts. And if there's slower moving structural shifts, you're not necessarily going to engender the same type of volatility on a sustained basis there. And that's one of the reasons why the VIX was so low. Now, right now, as you pointed out, the MOVE index, I think, is yanking the VIX up. And if you look at the two together over the last couple of weeks, they're kind of very similar. They really echo each other quite significantly.
So maybe the short story of this longer story, more volatility ahead.
That's
Michael Purves of Tallbacken Capital, thank you so much for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, Spotify shares are soaring after beating earnings expectations. The company says that it has reached a, quote, inflection point on profitability and expects more growth on the way. And with more subscribers looking for somewhere to stream their favorite tunes, there's been a steady rise of investors buying into music rights. There's a really interesting Bloomberg opinion column out there actually about investment fund Hypnosis, which has picked up the rights of some of these singers and songwriters. But it looks like maybe they top tick the market.
Yeah, and this is such a fickle market too, right? I mean, everyone says, oh yeah, this will be good. We'll buy up all these rights as they get streamed more and more. Then we'll make money. But tastes can change on a dime. What's hot today won't be hot tomorrow. Then you have like those weird things. Remember what was it a couple years ago when that guy was riding the skateboard in Ohio, in Idaho, listening to Fleetwood Mac, and then Dreams all of a sudden shot to like the #1 on the Billboard charts and made them like a gazillion
that's a
dollars.
great song.
50 years after the fact. I mean, it is. I'm not saying it's not, but I mean. there was probably like a 3-decade period where nobody was listening to that song outside of, Mike J and a few hippies, out in the back there. So.
That's true. There are some blue chip artists, though. You think about Bruce Springsteen, you think about Bob Dylan, but still, the market is fickle. We're going to continue to cover that market. This is The Close on Bloomberg.
This is the countdown to the close. Less than 30 minutes to go, Katie, until we get to the end of the trading day.
And actually, we're looking at close to session highs on the S&P 500. Those gains accelerating as we count down to that closing bell. And it's a big, broad rally, too. You take a look at what's doing well up at the top. You have utilities up by about 2.9%. Communication services and materials also having a good day as well. You go down to the bottom of the list. There's not too much red on the screen, but the red that is there is energy off by about 1%. But overall, it's a good day, Romaine.
Yeah, a good day here. I want to focus in on two interesting individual stories out there. The first is on basically what's been happening in the crypto space, a 7% run up in Bitcoin on the back of that optimism that a Bitcoin ETF, a spot Bitcoin ETF here in the U.S. might actually be coming sooner rather than later. You're seeing most of the stocks in the crypto space get a pretty strong bid, including MicroStrategy up 12%. But take a look at TransUnion, down 23%. This is the worst intraday drop for this stock on record here. Of course, this is a credit reporting firm. But here's the thing. If the banks aren't lending and people aren't borrowing, guess what? You don't necessarily need to run credit reports. And that's had a material impact on the fees that TransUnion charges. This is a big deal. You're seeing Experian drag down as well as a lot of its other competitors here. This is something to keep in mind that when we talk about sort of those lagged effects and more importantly, some of those ancillary consequences here of our current economic conditions, you're looking at it right there with TransUnion. Of course, this is a big day for earnings, a big week for earnings. We got Verizon earlier today. Those numbers were good. But Katie, we get a lot of earnings after the bell tonight, including from Chubb getting a nice bid on the day. Microsoft, Alphabet, and Visa also set to report.
Let's talk about this earnings season now with David Bailin. He is Chief Investment Officer over at Citi Global Wealth. David, it's great to have you with us because it is the busiest week of earnings season. And when you think about the narrative that's emerged over the past couple weeks, the past few months, it's been very doom and gloom. You have higher interest rates. Of course, you have geopolitical tensions on top of that, too, and political disarray. When you think about the reporting season that we're really just heading into now, do you expect that to add to the gloom or really change the narrative here?
I think it could change the narrative a little bit. About 2 weeks ago, we increased our GDP estimates for this year and for next year. And of course, at the same time, we're hearing about this fear of recession associated with rates and higher rates for longer. And those things are sort of crashing one against the other. The earnings season should actually be reasonably good, with the exception of companies that are directly impacted by higher rates. And you just saw the one you just mentioned, TransUnion, but also in the real estate sector, which is going to face a lot of headwinds. Plenty of other companies are going to see reasonable growth, and a lot of the tech companies and a lot of the transaction companies you just spoke about should have relatively good earnings compared to what expectations are. And so I think this clash is going to continue, but the real news is going to be economic resilience, which I think is we're going to see demonstrated in this quarter and next.
Well, I want to talk a little bit more about that playbook, about what companies don't necessarily feel the same sting from those higher rates. Romaine walked through a few, but when you think about the composition of sectors, different industries, which companies tend to be resilient in a higher interest rate environment?
Well, interestingly enough, first of all, profitable versus unprofitable companies. The market is very punishing of companies that aren't making any money, and certainly the most interest rate stocks are there. But when we think about growth stocks specifically, when we divide them into large, medium, and small, what's remarkable is that the market has punished small and medium-sized growth companies. They're trading at a 32% discount to their large counterparts. And that seems very odd to me, given that they've had a 10% growth rate in earnings, the profitable ones, for the last 5 years. So we're getting our clients focused on areas where you can get growth in a slow growth environment. And I think that's where we're going to find a lot of attractive values as we go into 2024.
It's interesting because a lot of companies, some corporations have basically said what you said, just the flip side of that from their perspective, whether it's, Mark Zuckerberg and his year of efficiency. But a lot of companies have really talked about this idea, pay less attention to revenue growth in total and pay a little bit more attention to our margins and our profitability here. My guess is, though, when you go through the S&P 500, there's a pretty small cohort of companies that are going to be able to pull that off.
Yes, I think certainly the larger companies are going to have a pretty significant time. What I'm seeing, though, in certain areas, in software in particular, is that you're seeing the benefit of AI just beginning now. You're seeing, in my mind, a reduction in actual labor cost, a slight pickup in efficiency. But what you're really seeing is the ability for certain companies to raise prices and have them stick without losing a lot of customers. And that, to me, is a sign of impact, where there's a dependency and an increased value that's being provided to each of their clients.
But when you look at sort of the market in aggregate and the potential gains that we could see over time, when you look at past cycles, a lot of that seemed to have been driven by growth, revenue growth in those individual names, and how that sort of all added up for the S&P as a whole. If that era is behind us, or at least maybe not going to be as pronounced as the previous eras here, does that mean that we should not expect sort of those high single-digit or double-digit % gains that people have gotten used to?
So when we look to 2024, I think that we're going to see moderating pressure on employment, and that is going to allow margin expansion in certain parts of the market. I think it's going to be a tale of two cities, right? For those companies that have competitive advantage, and a lot of the S&P ones do, they're going to be able to press that advantage at this time by using their technology and their information to drive revenues and results. I think you're going to see a lot of services companies benefit as a result of all of those efficiencies. And the industries that you would expect, the lower growth, sort of slower, more aging, lagging industries, are not going to see that benefit. The net of this is that we see earnings up in the S&P 5% next year from where they are now. And we see them up a total of 12% or more to 25. We could be at peak earnings in 2025. And if we were, certainly these stock prices are justified broadly.
And I want to bring bonds into this conversation because obviously it's been hard to have a conversation about the equity market over the past few months without talking about what's going on in yields. I want to talk about the idea of the year of the bond, since that was sort of the rallying cry coming into 2023. And it's been interesting that it feels like we talk mostly about bonds from a price return perspective. But when you think about a 10-year yield at 5%, is that compelling to you?
It's extremely compelling. Let's take a look let's break this thing down. So first of all, if you take a look at the tips, right, you're getting a 2.5% real yield on top of whatever inflation turns out to be. And that is historically in the 70th percentile of returns. That's very attractive. When we think about the absolute rate of return, an intermediate corporate bond with a 5-year duration, right, yielding a little more than 6%, that's an attractive rate of return. And so when we look at portfolios today, and given the scenario for equities, this is actually a very good time to have a 60-40 portfolio. What's the downside risk now of owning that intermediate portfolio? Relatively small. And so for the average investor, I think that this is a time to move from cash and to lock in these intermediate returns and put them into your portfolio.
All right, well, let's end it there then. David, it's great to see you in person to really enjoy this conversation. David Bailin of Citi Global Wealth, thank you so much. Now, coming up on the close, General Motors shares dropping after withdrawing guidance, of course, as the UAW enters its 6th week of striking. It's our Stock of the Hour coming up next. This is The Close on Bloomberg.
Welcome back. It's time now for our Stock of the Hour. A look at General Motors, down almost 3% here on the day. A reporting of results earlier this morning. They actually weren't bad, but the automaker cut its profit outlook, actually pulling its profit outlook altogether due to uncertainty driven by the strike going on with the UAW. Bloomberg Detroit Bureau Chief David Welch joining us right now to talk a little bit more about this. And I guess it's not a surprise that that uncertainty is there, but some investors seem to be rattled by this and maybe interpreting that this could go on for a little bit longer.
There's just risk that it will. And even though UAW President Shawn Fain said Friday that they were close, he also did say that the union may have to take some aggressive action to get the deal over the line with what they want. He also said that there's more money on the table. GM came out with pretty strong earnings, shows that there is money on the table and the union's going after it. Look, if it's open-ended like this and they could keep adding to the strikes, and the one strike they added today is at a very profitable plant, that tells you there's just a lot of risk to earnings that investors aren't going to like. Add in the news about GM's self-driving car unit being suspended today, and it's kind of a no-good, miserable day for CEO Mary Barra, and apparently for shareholders too.
Well, let's talk about that. I mean, about with Cruise. I mean, this was a pretty ambitious project. Of course, they acquired this company, really sort of built it out here, and we're testing these vehicles out in California. But we now learned from our reporters that California has suspended that Cruise unit from operating those driverless vehicles, and this apparently has something to do with some accidents and the way that GM, or Cruise, I should say, reported those accidents to authorities.
That's right. The first accident, a Cruise vehicle got in a crash with a fire truck. And there was already scrutiny of Cruise and Waymo vehicles for interfering with emergency responders on various scenes. But the crash with the fire truck was a pretty bad one. This other one, a Cruise vehicle actually ran over a person, but it was after a human driver in another car struck the pedestrian and launched the person in front of the Cruise vehicle. And at first it seemed like it was really, this is the fault of the hit and run driver, but the problem is the Cruise vehicle stopped when it was over the person and continued to drive for another 20 feet because the car was trying to pull over to a safe spot, but the person was under there and dragged the person. So this is a pretty grisly accident, very rare occurrence, obviously, but still, when that happens, you're going to get scrutiny from regulators. And after reviewing this since early October, the California DMV suspended their license.
Yeah, like you said, definitely something that would attract regulatory scrutiny. Let's talk about GM earnings overall, though, because outside of the guidance withdrawal and, of course, the uncertainty around the profit outlook that, isn't there anymore, it was a pretty good quarter, David.
Well, it was a very solid quarter. Look, they beat the consensus estimate by, I think it was almost 40 cents. So solid quarter there. They grew revenue. Revenue also beat expectations. They grew market share in the U.S., their biggest market and their most profitable one. And they offset things like tough times in China and higher interest rates, which cut into the earnings for their GM Financial lending unit. There's some just kind of macro headwinds that everyone's dealing with, but GM still had a very good quarter. If it weren't for the strike, they would have matched last year's third quarter profits when they didn't have some of these issues going on. So yeah, very solid. Continue to get good pricing on their vehicles, but everything's overshadowed by the strike. So look, operationally, the car business is doing well, but expansion into EVs, they're pulling on that a little bit, and the autonomous vehicle story is not a very good one at all for them right now. So I think investors are looking at all of this and thinking, all right, maybe there's another day to go back and buy GM shares, but today's not it.
And David, just really quickly, we did hear from GM saying that strike costs so far $800 million, an additional $200 million a week. Are we expecting similar figures from Ford and Stellantis when it comes to these strike costs?
I think we might have lost David's connection. Our thanks there to David Welch, Bloomberg Detroit Bureau Chief here. A look at General Motors. Our stock at the hour down 2.7% on the day, but we should point out even prior to today, this was a stock that was down about 25% over the past 3 months alone. A lot of broader concerns here about its ability to continuing delivering on those vehicles. Coming up here, we're going to deliver to you our coverage of the close as we move closer to those bells. Sherry Paul, Private Wealth Advisor and Senior Portfolio Manager at Morgan Stanley Private Wealth. She's going to be stopping by the big program to give us insights on what's been happening today. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick still here. Scarlet Food popping up as she does every day at this time to help us count down to those closing bells and take us to the bell and beyond. Busy day once we get after the bell, Scarlet. We have a lot of earnings to focus on here. But this is probably the first day in a while where we haven't really obsessed over the moves in the Treasury market and how it's batting everything else around.
I know, right? I mean, 4 basis point move, 5 basis point move. It's ho-hum in the Treasury market. They're not a driving force. 4,200 for the S&P 500 has proven to be a durable support level. And, of course, going forward, it all depends on what Microsoft and Alphabet say. And after that, what Amazon and Meta say later on this week, whether we stay above 4,200 or not.
Yeah, well, the good thing is, I mean, you just named probably 4 of the 6 most profitable companies in the S&P 500. So if they don't save us, then I think no one will.
Yeah, then watch out below maybe.
Yeah. All right. Well, a lot to parse here as we get closer to these bells. A lot to parse once we get beyond the bells. Sherry Paul joining us right now to help walk us there. Private Wealth Advisor and Senior Portfolio Manager at Morgan Stanley Private Wealth Management. Pleased to have you here in studio. Let's start off with earnings because, of course, we are going to get the big dogs, a couple of the big dogs tonight here. And, you know, when you look at those companies, they almost seem like anomalies. I mean, they have good growth stories. They obviously have the profitability, though some people might look at the valuations and say they're a little stretched. Can they still be kind of the salve or the salvation for this market?
Well, I think they definitely continue to play a crucial role in the market. And, you know, despite what most people thought this year was going to look like, we've got pretty good earnings. We've got a pretty strong consumer. We have an increasingly complex world. The geopolitical landscape has gotten extremely challenging. And we're really looking at what I'm calling this is like an eyes wide open type market, and this is an investor's market, not a market timing market for that reason. Really encouraging investors not to get head faked into market timing due to geopolitics. It's a bad practice. Lots of history shows us that. And instead looking at, you know, the fact that we're in a meaningful moment of thematic change going forward, and there's a lot of opportunity there.
It's interesting to use the phrase eyes wide open because I'm sure, as you know, a lot of investors really just don't even want to look right now. They've either moved to the sidelines or allocated a significant part of their portfolio to things that, at least in their view, are going to be a lot less risky.
Yeah, well, look, you know, I think people are back to change fatigue. I talked about this even during the pandemic. We're in this moment now of these themes that are really accelerating around artificial intelligence, around deglobalization, around, you know, the role that politics plays in the supply chain. And then, you know, which I believe, frankly, is going to turn into an accelerant for AI to be installed and replacing humans in the workplace, because when you do that, you can avoid the geopolitics of having to move human capital and supply around the planet. And the way that frankly, that the pandemic did for accelerating the remote of everything, which is what we were calling it during that transition. So we're in another seminal moment, and yeah, people want to close their eyes to it, but it's really important that we sit in that seat of awareness, consciously make decisions, and if we do that, we can get to good portfolio outcomes. I really believe that.
So people are closing their eyes and putting their money in cash because it does yield something. They're also doing that with big tech, and big tech is the most crowded trade out there among fund managers, according to B of A. AI and how it transforms everything is definitely a long-term narrative. But for now, what is the risk that investors read far too much into these latest set of results that we're going to get?
You know, you make such a good point. Too much of a good thing is always a bad thing. Like, period, end of story. It's a very simple setup in this market right now, which is you should definitely have an allocation to cash. You're getting 5% on a fairly riskless basis. You know, we favor the short end of the bond curve. Don't get cute trying to trade the bond market or yields where we are right now. Very U.S.-centered and diversified with selective technology, but there have been so many underperformers. I mean, you know, healthcare, financials, materials, industrials, all of these things that are going to be the juggernaut going forward and what will become the new world economy have all underperformed this year. So it's a fantastic way to rebalance portfolios, especially here at the end of the year, out of those crowded trades into, you know, terrific companies that have, you know, amazing kind of innovative prospects, particularly in healthcare.
What do you think about the big energy companies or energy companies in general? Because there's definitely a wave of consolidation taking place with some of the biggest companies getting bigger and continuing to bet on fossil fuels.
Well, you know, look, in that space, bigger is better, right? But that's also where the biggest political football in the world sits at this point. And so I think there are a lot of other areas of the market that you can really step into that will have a better risk-adjusted return, including dividend and yield. Not to mention, just it's very hard to quantify that space right now because of how politicized it is. So I would turn investors really meaningfully towards industrials, healthcare, some materials, staple stocks, selective tech.
Staples. Consumer staples?
Yeah, some consumer staples. Well, you know, I think that I go back to a philosophy of all-weather portfolios, right? Well, the conditions have changed. We're in a different weather system right now with 2 declared military conflicts. And those are just the ones that are declared. And so to have some defenses in the portfolio that are giving terrific dividends and yields, I think is really a smart thing to do.
Yeah, I mean, there's this idea, though, too, that if you are a little bit more pessimistic and you are concerned about economic conditions, that you gravitate, at least historically, you gravitate to things like staples, healthcare that you also pointed out, things that have that sort of a recession resistance, if you will. But why is it that we still see people go into Microsoft and Amazon and NVIDIA as a safety trade, not necessarily a growth trade, but as a safety trade?
Well, you know, it makes so much sense. I mean, you just look at their balance sheets. These are like the new Bells. I mean, you know, so Microsoft is like a new sort of These tech companies have become essential staples in many ways. This is one of the things, too, that's transforming is how we actually define and catalog these companies across the S&P. That's why we're seeing the crowded trades, because we want to continue to put things in a box they don't fit in. And that would go for even portfolio structure and how people are viewing the world. Like, we're not going back to the way that things were. So the best course is to have acceptance around that and stop putting things that don't fit into the past and instead start mindfully looking at what this future is going to look like. It's going to be very different than where we are now.
What's the level of anxiety of this need to have to do something, adjust your portfolio right now as we head towards year end?
Yeah, such a good question. You know, people feel the need to take control where they can in a world that feels so out of control. And so my encouragement there is for individual investors that are trading their own money, but for our clients, you know, that sits inside of a financial planning narrative that becomes the guardrails for erratic activity, for the sake of being busy. So, you know, go to a spin class, hit the gym, make a great dinner, have some, you know, good time with friends, but don't over tinker with the portfolios and the climate that we're in.
All right, well said, Sherry Paul. Morgan Stanley, Private Wealth Management. Just get outside and take it easy and let your portfolio do the work for you, Scarlet. I know you've probably, what are you, like allocated into like 100% bonds now?
110% bonds. How about that?
Oh, so you're over your leverage.
Over leverage, absolutely.
Smart. In all seriousness, though, I mean, and Sherry talks about this idea of sort of being at this inflection point on a lot of these issues like AI, even geopolitics. And you wonder, though, for all the opportunity there, that does scare some people away.
It totally scares some people, but I think a lot of people have probably made their bets and are just ready to let it sit and see what plays out over the next couple of months.
All right. Well, we got to get ready here, Scarlet. I hope you've drank some water and ate.
I have all my notes for all these earnings.
We've got some big earnings coming up here in just a couple of minutes, moving closer to those closing bells. The full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine, Bostick alongside Scarlet Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms as we watch a market creep higher here into the close, and we keep an eye on a slate of some big earnings that'll come once those bells ring.
Yeah, Microsoft. We've got Alphabet. They're certainly going to be front and center. These are names that certainly can impact the market moves and the trends that we see. So that is front and center. Having said that, before we get into all of that, those Chinese names that trade in the United States, you know I'm obsessed with this. President Xi kicking in some new economic stimulus overnight, and that group as a whole up about 4% in today's
trade. Not only
guys.
economic stimulus, did you see he actually went down to the PBOC?
Which he never does or hasn't done in a long time. So that was a big deal.
Yeah. They don't even do that in this country. Does the president just go down and like rattle Jay Powell's cage?
We actually don't like, I think, when that happens.
Yeah. How did that basket of stocks do last year? How did it do the year before?
All right, perspective.
Yeah. Sorry.
It's just Tim perspective.
I'm sorry. Okay, back to the big earnings that are coming.
I thought you were my friend.
I am your friend. I just got when in doubt, zoom out. That's what you got to do. Okay.
Oh, nice, very nice.
So I'm thinking about Microsoft after the bell. I'm thinking about what they're going to say about AI, what they're going to say about the cloud. Expectations are certainly high, and then of course Alphabet. Are we seeing a return to growth when it comes to digital ads? And what are digital ad sales telling us about the greater economy?
Or how much are they getting a boost in YouTube TV subscriptions because of Monday Night Football, not Monday Night Football, Sunday Ticket, right?
That sounds
Monday
like you
night,
have
Tuesday
a
night,
business
Wednesday
of sports
night
podcast, Scarlet. Sounds like you have a business of sports podcast.
Yeah. Well, we pay attention to all
Let's
that.
walk through the numbers real quickly here as we await some of those earnings across the wire. The Dow Jones Industrial Average in the green on the day, up by about 200 points or 0.6% as we wait for these numbers to settle down just a bit. But the S&P 500 is going to finish higher by about 30 points or 0.7%, while the NASDAQ Composite higher by about 121 points or 0.9%, while the Russell 2000 closing out the day with a gain of about 0.8%.
All right, as we await those earnings, quick check on the S&P 500. 346 names. Scarlet higher in today's session, 155 to the downside, 2 unchanged.
Yeah, and looking at the sector breakdown, overwhelmingly to the upside. Telecom, utilities, and autos leading the way. Telecom, of course, getting a big, huge lift from Verizon. That group up almost 6%. On the downside, energy tracking lower with oil prices, transportation, and commercial and professional services all down.
All right, so let's get to it. I mentioned Chinese names, definitely an outperformer in today's session. And we do have Microsoft. I'm thinking we should go right there, guys.
Yeah, let's go right to Microsoft. Those earnings crossing the wire right now. The headline number coming in here with revenue for that fiscal first quarter, $56.5 billion, a slight beat over street estimates of $54.5. EPS for the quarter coming in at $2.99. Not quite sure of the comparison there, but let's go through a couple of the segments here. Personal computing revenue coming in at $13.67 billion. That's a beat. The intelligent cloud revenue business coming in at $24.26 billion. That's also a beat. And the productivity revenue coming in at $18.59 billion. That's also a beat. Remember, of course, Microsoft doesn't actually provide any guidance until the conference call, so we're going to have to wait a little bit longer to get that.
Check it out. Up 3.5%, up 4% in the after hours. Did you guys see, too, that they returned, $9.1 billion to shareholders?
Yeah, I'm going through the press release right now, and we're seeing a lot of mentions of AI. We've got Satya Nadella coming out and saying, with copilots, we're making the age of AI real for people and businesses everywhere. He said, quote, we are rapidly infusing AI across every layer of the tech stack and for every role in business process to drive productivity gains for our customers.
And of course, the Copilot software for Microsoft 365 comes out on November 1st. So any kind of commentary and color that they give on exactly how it's doing in the lead up to that matters.
All right, let's go. You guys want to go to Alphabet?
Yeah, let's do it.
All right, let's do it here. Those numbers crossing the wire right now. They report on the third quarter on the calendar side here. Cloud revenue coming in at $8.4 billion. Ooh. That's a slight miss. YouTube ad revenue, Scarlet, $7.95 billion. That's a slight beat. Total ad revenue, $59.65 billion. That's a slight beat as well. Their EPS, the bottom line number, $1.55. The street was looking for $1.45 on average. Those are the main numbers that I'm looking at right now. Guys, what jumps out at you?
Operating income coming in a little bit lighter than anticipated, $21.34 billion. Analysts were looking for $21.4. Other revenue, which is just kind of a big, broad category of $8.3 billion. Analysts were looking for $7.9 billion. It's going to be interesting to hear what the company has to say about the Google Cloud business after it just turned a profit, seeing this miss for the revenue line.
I would just like to point out another headline that's crossing the wire, and this is more on the cost side. They're taking actions to optimize global office space. So I don't know, read between the corporate speak there. And
Are they listening to Steve Schwartzman? Maybe?
No, I mean, they're doing the opposite.
Steve Schwartzman is going to be mad.
They're doing the opposite of what Steve Schwartzman wants to do, but that's tech. I mean, that's tech, that's Silicon Valley.
When he gets back
that's
to
what
the
engineers
office,
have the power
really
to do.
upset.
That's the engineer speaking, saying we want to work from wherever.
Exactly, and the companies say, okay, you're the engineers, you can do whatever you want. The CFO, Ruth Porat, also president and chief investment officer, we got to get her title right, talked about the cloud business. She said the meaningful growth in search and YouTube, momentum in the cloud. Here's some important language. We continue to focus on judicious capital allocation to deliver sustainable financial value. That's the CFO saying, hey, just like Mark Zuckerberg said last year, it's a year of efficiency.
Yeah, absolutely. Here, can we just break away just a quick second from Alphabet and Microsoft? Texas Instruments crossing the wire right now. Those shares actually down pretty heavily here in after-hours trading, about 5% here. And it looks like this has to do with the guidance here. They're giving 4Q revenue guidance of $3.93 billion to $4.27 billion. The top end of that range is below the average of street estimates here. So not quite seeing the reason here. But when you go through some of the numbers for the most recent quarter, that third quarter that just reported here, they did actually beat on a lot of key metrics, including on certain revenue as well as on operating profits here, but missing on a lot of other key metrics as well.
You know, it's interesting, too. I'm looking at the NASDAQ E-mini futures in the after hours, and they're just up about 0.8%. Keep in mind that, these are names, Google, Alphabet, specifically Microsoft, that can often and typically do move this index. But right now we're just seeing it up just shy of 1%. So just maybe a little bit of an indication, it's early yet, of how maybe this might impact tomorrow's trade.
Yeah, Texas Instruments also missing on the bottom line when it comes to its fourth quarter forecast for earnings per share. Estimate was for $1.76 per share, coming with estimates that say $1.35 to $1.57. Shares now down 4.4% in the after hours.
And it's not a great read through for the rest of the chip industry as well. If we were looking for Texas Instruments to provide any kind of indication that that slump is over or has bottomed out, this suggests that perhaps there's still a ways to go.
Well, they play into the automotive sector, into electronics, and you do wonder whether or not this, they've seen some pressure, they've been under pressure. You do wonder, too, about, the follow-through in terms of those sectors in particular. I am curious, though, too. I mean, when we talk about this, we focus so much on the consumer side of this, and I do wonder, when you talk about corporate spend and their CapEx spending and their sort of build-out of a lot of these things,
earnings, whether that is going to really finally start to trickle into these earnings. Because when I hear one company say we're pulling back on CapEx spending, or they're pulling it back on marketing and other spending here, I wonder how that feeds into the other corporations that they depend on for the certain services.
The supply chains, right?
Yeah,
like you think about their whole supply chain and the impact ultimately. Very interesting in terms of what we've seen so far. I'm kind of waiting for Visa to get another read on the consumer, because we get kind of some mixed reading, right? We had a strong retail sales report. We got Hermes coming in today that was under some pressure. And so it'll be interesting to see ultimately what we see, but not crossing yet.
All right, Sundar Pichai in the press release of Alphabet, the CEO of Alphabet, saying, quote, I'm pleased with our financial results. He added that AI-driven innovations across search, YouTube, cloud, Pixel devices, and more. He said that we're continuing to focus on making AI more helpful for everyone. There's exciting progress and lots more to come. I know we've been talking about AI for the last 6 months, 8 months, but these companies have been using AI and just not talking about it for quite a bit of time. I mean, think about Gmail, for example.
And just real quick, there was a great BI piece. I forgot Bloomberg Intelligence piece that really talked about the disconnect between the revenue growth you're seeing in the AI space and the lack of profitability.
All right, really good point. Hey, I mentioned Visa coming out and just crossing the Bloomberg terminal. Fourth quarter adjusted EPS, slight beat, $2.33 a share. The estimate was for $2.24 a share. Let's get to the top line. Fourth quarter net revenue, $8.6 billion. That's a beat. The estimate was for $8.56, and the company authorizing a new $25 billion multi-year share buyback
That sounds
program.
big. That sounds big.
Well, there's a story on the Bloomberg about how we're not seeing maybe as many buybacks, which has provided some momentum, certainly on the equity side.
Yeah.
Cross-border volumes at constant currency up 16%. Visa processed transactions, 56 billion, a little bit higher than what the street was expecting, 55.75 in Visa, you guys, up about 1.7% in the after hours.
I'm curious to hear what they have to say about this Fed meeting that's coming up, where they're discussing the cap on interchange fees. Yeah, because it's been something that's obviously pretty lucrative for Visa and MasterCard, but a lot of Congress and a lot of the central bank is looking at maybe changing that up.
Yeah, and the stocks were under pressure, right? When that news kind of crossed, I think, according to folks familiar. But yeah, so we'll keep an eye. Anyway, Google under pressure. We've got Microsoft rallying, a lot going on. So we'll continue. I know you guys are going to continue to track, and we will too. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals, guys. We will see you again tomorrow.
And we continue our coverage here on Bloomberg Television as we keep an eye on what's been going on with the various earnings going on out there right now. Right now, looking at Google, Alphabet, right now on the back foot. Microsoft getting a pretty decent bid. Joining us right now to talk a little bit more about this, let's go to Mandeep Singh, Bloomberg Intelligence analyst, joining us right now. Anurag Rana also going to be joining us from Chicago to help break down this earnings. But I'll start with you, Mandeep, since you're right here next to us here. What was your first impression here out of the results?
I mean, search remarkably resilient when you think of, a business at over $150 billion run rate, growing double digits, and all the talk about ChatGPT taking share, hurting. Obviously, that hasn't materialized. Cloud, a little bit of a letdown, but not surprised given, everyone right now is talking about generative AI and they are kind of making their 2024 plans. It hasn't really translated into cloud revenue. So guidance would be interesting on that front.
Well, that's what I'm curious about. I mean, the share reaction seems to be tied to some of the numbers out of that cloud unit, a unit that basically didn't exist a few years ago. And last time I checked, it's come up to maybe about 10% or so of revenue. So it's growing pretty fast. And I guess people want to know just how competitive can they be in that space? And does this become a much more dominant part of their business?
It will. I mean, to my mind, they are a leader in the large language model field. They have trained a lot of their large language models, and I think they have the apparatus to offer other companies to do the same. The good thing with Alphabet is they don't have a legacy business that's going to get cannibalized like Microsoft. I mean, Anurag can tell more, but clearly, they don't have any on-prem business. It's all in the cloud, and we know this is what everyone wants. So it's just a matter of when the demand will come back for cloud capacity, and that way, I do think they are positioned very well.
All right, let's bring in Anurag Rana, who, of course, covers software companies and can give us a read on Microsoft. Looking at shares of Microsoft, they are rising in after-hours trade. What in particular were investors fixated on? I know Azure and any mention of AI is top of mind, but I bring this up because there's some disappointment during the last earnings season with how much Microsoft was spending in order to really capitalize on its AI capabilities.
Yeah, the Azure growth did stand out to us. They guided for 25 to 26%, and they came out at 28. So that's really a positive sign. But the real kicker is going to be when we find out on the conference call what the guidance for next quarter is going to be. Whether this quarter was an aberration or we continue to see demand for a lot of their cloud services continue. I think that really will dictate the momentum, not just for Microsoft, but almost the entire software industry.
In conversation right now with Anurag Rana over at Bloomberg Intelligence, a closer look at Microsoft. We also have Mandeep Singh with us, also from Bloomberg Intelligence, who joined us today to talk a little bit about Alphabet. But we want to break some news right now involving Snap. Those shares higher by more than 20% here in after hours trading after the company came out with earnings that beat on a lot of key metrics, including a big beat on revenue, a pretty significant beat on EBITDA. In fact, they actually posted EBITDA of $40 million. The street was actually looking for a loss of about $64 million. The company also beat on active users, and it said that is going to institute a buyback of about 500 million shares. And Mandeep, I just want to get your thoughts on this real quick before we go back to Anurag here. Snap, it kind of seems to be one of those social media companies that we stopped talking about, though I should point out that at least for the underage people in my household, that is their preferred platform of choice.
It is, and look, Meta had a lawsuit today from various attorney generals talking about, the content and the ads they show. So Snap also, I think, falls in that realm, even though there isn't any lawsuit. But look, anytime you have a platform that has got 400 million daily active users, they've got the attention. And ad business is cyclical. We know that it will come back. The problem that these guys have is they don't have the scale that Meta and Alphabet have, which is why advertisers go to them first, but clearly there's a trickle-down effect, and if there is an ad rebound, Snapchat, Pinterest, all these platforms also participate.
Yeah, and that, by the way, that segment of population that does use Snap, very, very sticky, as Romaine and I can attest to. Anurag, let's bring you back in here for the final word on Microsoft. We fixate so much on Azure, on AI, and until we get the forecast, we don't really know how the company is positioning itself. But I did want to ask you about the legacy business, which is Office and other applications with regard to productivity. This is a big part of Microsoft nonetheless, because it does drive its earnings, doesn't it?
Yes, I mean, but those businesses don't really swing up and down that much. Those are very steady Eddie businesses, 8 to 10% growth, maybe 12% depending on the quarter. So right now we are not expecting any major bump in that. It's going to take at least 1 to 2 years before we really see some benefits of AI onto that portfolio. So but all eyes are on Azure guidance for next quarter, and that's the most important thing for us.
All right, Anurag, always appreciate you jumping on for us. Anurag Rana, one of the best of Bloomberg Intelligence. And to my right there is Mandeep Singh, also of Bloomberg Intelligence, helping break down our earnings. Our thanks to both of them. We're going to say goodbye to them and let them get back to work. But we're going to continue our conversation here on the big releases that we just got. Just a quick step back here. Alphabet earnings are out here, reporting revenue and profit from a cloud business that missed analyst estimates. That's pushing the shares lower by 6%, while Microsoft shares are higher after it posted stronger than expected first quarter sales. Jeremy Bryan joining us right now, portfolio manager over at Gradient Investments, which has about $5 billion in assets under management and does hold positions in both Microsoft and Alphabet. Let's start with Microsoft here because it seems like the more complex company, at least in terms of the various sort of business units it has. And it almost seems to a certain extent, I don't want to be too glib about it, but it almost seems unstoppable to a certain extent.
Pretty close. Especially the things that we're looking at, right, is what is the next generation? That's what people want to know, right? When you're investing in growthier type of stocks, who's going to take share in the next generation? Well, Microsoft has everything you want in that space, and they are pretty much the leader in that space. So it's really hard for us to say that there is a significant negative case outside of somebody coming in and actually doing something better that takes their business away, which historically has not proven that Microsoft takes that very lightly. So in our regard, nothing's ever bulletproof, but especially with these numbers, what we're seeing is still just very good trends for the company overall.
I am curious, though, when you look at the valuations and the run-up that we've seen in Microsoft, as well as a lot of the other big tech cohorts, whether you're comfortable with those valuations in the light of an environment that, when you look ahead, does seem to be still a little uncertain.
Yeah, it's a great question because honestly, as much as I was just saying how positive we are, we're actually slightly underweight. We're actually slightly underweight Microsoft, and it's much more a call on our side. And we took some profits earlier to kind of trim our position overall just into this earnings. And then also from the perspective of just the concentration it has as part of the overall market isn't an area where if we thought we were overweight, that puts a significant risk of that one position having a really detrimental impact on our portfolio. So while we really like Microsoft, we really like what it offers, it is hard for us right now, given the valuation, what we're paying for it, and also its concentration of being an overweight position in there. So we still hold it, but we're not significantly of incremental size over what's already in the S&P 500.
You know, I'm looking at the share price reaction in after hours trading, and it's interesting to see Microsoft moving up by about 5% and Alphabet moving down by about 6%, because after their last earnings report, they moved in the opposite directions. And perhaps the bar was a bit lower here for Alphabet to beat and to impress investors. How does that factor into how you're thinking about Alphabet?
Yeah, honestly, I think the bar was set a little bit higher on Alphabet just simply because of the performance since the last earnings, right? Performance since the last earnings call was 14% in a down 7 market. So you've had a really significant upside coming into, and you saw, I think the bar was relatively low on advertising spend, and I think they actually exceeded that bar. What was a little bit different is that the price performance may have incorporated some of that already to where people were looking for maybe more significant upside just from the revenue perspective, but certainly maybe a little bit more leverage on the bottom line. And so now, again, we don't use aftermarket as the end-all, be-all. This could be very different tomorrow, and in 15 minutes it could be different too. We're going to look through the numbers a little bit more, but what we saw just on the surface actually wasn't that bad. I think there was just a higher level of expectation coming in.
Yeah, I misspoke there in terms of the expectations going into the Alphabet results. I want to get your take on expenses as well. As Romaine was telling us, Alphabet, including in its press release, that it's taking actions to optimize global office space. It sounds like it doesn't want to pay as much rent, and a lot of people will be working from home. Expenses are definitely something to watch for when it comes to Alphabet. How much fat is there still left to be cut, given the cost controls it's already implemented?
Yeah, from our side, it's not as much, is there a lot of fat to cut? It's much more, can they scale and get margin from their growing businesses, right? YouTube starts to grow and accelerate. The revenue from cloud starts to grow and accelerate. Can they do that with the same op structure that they already have that gives them a natural tailwind to margins? That's much more important to us than them actually doing initiatives. I mean, obviously consolidating office space, it's great to talk about. Working more from home, it'll probably enhance the leverage a little bit for them, but it's much more for them the natural leverage that comes from being a growth company. And can they do that without adding a lot of OpEx to their bottom line?
This gets to the question too. We're talking about two stocks here, Jeremy, that are just juggernauts. Two companies, I should say here. Obviously, big weightings in the S&P, but two of the most profitable companies in the S&P 500. And we talk about this idea here of what the growth story is going to be. When you're this big, obviously you just cannot continue growing at double-digit percentages, or at least history would say that that's not sustainable here. What's the pivot for Satya Nadella or Sundar Pichai going forward here to sort of maybe sustain some of this growth for a much longer term, maybe even long after they're gone and moved on to other jobs?
Yeah, growth of technology and making sure you don't lose share. I think that's the biggest thing, right? Because we've been talking about kind of a ceiling on Azure for, a year, maybe 2 years or more. Hey, it can't grow. And certainly there's been a deceleration during that time, right? But a very large company is still growing probably their most important business at a 28% constant currency rate. That's amazing. Now, can they continue that for 10 years down the road? Probably not. But what they can continue to do is, especially as we continue to grow AI and other things that become the next generation of consumer and technology spend, they just need to ensure that they're either 1, 2, or 3 in those spaces, because there is no room for them to lose significant amounts of share, just given that, as you said, the behemoth that they are and the amount of revenue they need to generate to continue to grow.
All right, Jeremy, always great to catch up with you. Jeremy Bryan there. He's a portfolio manager over at Gradient Investments, which has positions in both Microsoft and Alphabet. Microsoft shares one of the big after-hours mover here, up about 4% here on the day. Meanwhile, Alphabet shares going on in the opposite direction. Coming up here, a lot more earnings coverage, including a closer look at what we learned from Visa. That's coming up after the break on The Close on Bloomberg. Let's get some more insight on the health of the consumer. The results out of Visa just crossing the wire a little while ago. A pretty big beat on adjusted EPS here, and a pretty big beat when it comes to payments volume, up about 9% on a year-over-year basis, about a percentage point higher than what the street was expecting. But there are some concerns about the economy and concerns about some potential regulation that could crimp some of the fees it charges. Bryan Riley joining us right now, Director of Credit Advisory Services and Co-Head of Payments over at Javelin Strategy and Research. And Bryan, I do want to start off here with some of the fees that they charge, and more importantly, the potential that the Fed is going to actually sort of lower the cap, I guess, of what they're able to sort of pass along to their retail partners. Are you concerned?
Well, it's certainly something to watch for. And when Dodd-Frank went in, it did establish price controls on debit cards particularly, and those went down to 21 cents per transaction and a 0.05% for the value of the transaction. So the question is, how low can it go? And that's something to watch. And we're at a tender point in the industry where we start looking at the economy and other factors, shifts in payment habits. So that's certainly a concern that you have to have when you're looking at the business model for payments.
Is there any chance that the Fed will raise the cap or adjust it in such a way that the fees won't actually change that much at the end of the day?
Well, the Fed has to act cautiously, right? It's had some really dramatic moves on interest rates, and those have downstream effects to everyone who holds a payment card, and those also that don't. So you have to. I don't expect to see any radical change there. Mm-hmm. There could be a case for moving it down slightly, ever so slightly. It's not likely that number will go up.
There's been a lot of discussion here, about the way people sort of view these fees. I mean, let's face it, that the average consumer, when they hear about these fees, particularly in aggregate, and they hear, $100 and something billion was charged, everyone gets outraged, Bryan. But put it into context as to why they're charging these fees, and more importantly, are the people on the other end of this, are they generally okay with this? Because this also, I would think, that rise in fees comes also with a rise in actual transactions.
Yeah, and that's the big driver here. You hear a lot of noise about rates are going off the charts, and that's really not the case. The volumes are going up. You talked about Visa's numbers going up 9% just a moment ago. The standard growth rate in this industry is about 8% a year. So as those grow, certainly the amount charged for them. 50 years ago when this business was started by MasterCard and Visa, it was a highly speculative area, and it fundamentally took the equivalent of a check processing network and became a universal way to match consumers and merchants at the point of sale. And everybody's enjoyed that lift. You can certainly probably don't leave home without your credit cards in the pocket or debit cards. And it's an essential way that we do business. And even if you look at how the use of cash has shifted over the years,
right.
It's really
Bryan, sorry to jump in. I'm curious, what are the economics of how interchange fees work in places like the European markets, like Scandinavia, where cash is almost non-existent for transactions in Sweden? How do they work there? What kind of fees are being charged there versus here?
Well, here in the United States, on the credit side, certainly they are the highest, or among the highest rates in the world. Our model is very different than, say, the European model. If you look at the pricing of it, they tend to have annual fees that drive the business. Mm-hmm. They also have much different reward structures. That's on the credit side of the house. On the debit side of the house, where the rates are just about half of what credit cards are, the model relies on it. It fills a lot. When you start looking at what happened during the first change, you saw free checking accounts slow down. The other factors that go into banking. Something that's also not looked at frequently when you look at the cost of a merchant. Mm-hmm. who has to do that. Is uneven pricing. If you're a large retailer, you might have negotiated rates. That comes into play here. Also, there's other fees that have nothing to do with interchange, but they have to do with connecting to the payment system. Sometimes the processor might charge monthly fees or maintenance fees, statement fees.
All right, we're going to have to leave it there, Bryan. Great to catch up with you. Bryan Rowley, Director of Credit Advisory Services over at Javelin Strategy. Some breaking news crossing the wire down in Washington. We're now learning that the lack of a Speaker of the House of Representatives here in the U.S. will continue longer. Tom Emmer, of course, the Republican from Minnesota, has ended his Speaker's bid, becoming the third GOP nominee to fail. Emmer, remember, earlier in the day, won a straw poll to be the GOP nominee. Some modest gains here on the day for U.S. equity markets, with the S&P moving higher by about 0.7%. Most of the other major indices also posting similar gains here on the day. Not a whole lot of conviction behind those trades, but with some tamped down volatility in the Treasury market, that did provide a bit of clearance for investors to go around and try and pick and choose what they wanted to buy. You saw that played out heavily in the semiconductor space, with the Philadelphia Semiconductor Index up more than 1% on the day. And you even saw some of the healthcare trades, as well as some of those cyclical trades get a bid as well. Once again, this wasn't a strong bid in, but it's something that is providing a bit of a salve for this market that is looking for any sort of reason to continue to move higher. Of course, Scarlet, a big part of that move higher is going to be dependent on what we hear out of some of the big companies that are reporting earnings this week, a couple of which we've just heard from just a few minutes ago.
Yep, starting with Alphabet. The stock is lower in after-hours trading by almost 5% after it reported revenue and profit from its cloud business that missed analyst estimates. Again, the stock falling in after-hours trading. Let's bring in now Bloomberg Technology co-host Ed Ludlow, who just spoke with the company's CFO, Ruth Porat. She's also now the CIO of the firm as well, overseeing the Other Bets business. And Ed Ludlow joins us now. Ed, what did you learn?
Well, that Google Cloud number, $8.41 billion in the quarter below estimates, is principally attributable to what Ruth Porat called customer cost optimizations in the third quarter. It's something that we've kind of heard all year long, that irrespective of the hype around AI, a lot of cloud customers are choosing to dial back their spend or go for lower cost products on the hyperscale or cloud side, and that is kind of what played out in the third quarter, GCP revenue being that Google Cloud unit revenue. What she did say is that when you think about AI holistically, there is a lot of backlog of demand, and some of the compute tools that are AI-based, that are cloud-based as well, they've just made generally available to its customer base. They'll continue to invest to support that. That's a big part of her role now, right? Expanded from being just CFO to being president and CIO. It's about working with Sundar Pichai and the sales team to kind of continue to invest to support infrastructure. Outside of that, she has got an expanded role where she's looking at other bets. And if you kind of look at the breakdown of segments, it was only cloud that really missed street estimates. They seem relatively bullish. Stabilization in the ad business, resilience in the search business as well.
I am curious, though, Ed. I mean, you talk about the way that she's having to work with Pichai and sort of help shepherd this as CFO, but we know that at some point she's not going to be the CFO anymore. She's going to just assume that role of Chief Investment Officer. Did they give any sort of update as to who's actually going to replace her as CFO?
No update as to who's going to replace her. And what's so interesting is she kind of came back to me really quickly when I asked exactly that and said, I'm still the CFO. I still manage capital spending, capital planning, and I'll continue to do that. Very much framing it as an expanded policy role as much as anything, kind of looking at how Google operates around the world, investing not just in the United States, but in overseas markets, and then adding this kind of policy role to her remit as well. But yeah, for now, I am the CFO as well, was very much the message.
Well, she certainly still is, but at some point you need to have a succession plan. Ed Ludlow, the co-host of Bloomberg Technology, there, fresh off the phone with Ruth Porat, the CFO, still, I'm told, as well as the CIO over at Alphabet. All right, we want to continue here with the focus on earnings, particularly with some of these big cap tech companies. Meta earnings are on tap in about 24 hours. Rohit Kulkarni joining us. He's a senior research analyst over at Roth Capital Partners. And Rohit, let's start off here. I mean, Meta is kind of its own animal here. I know there are some parallels you can maybe draw with Google and the ad business here, but was there anything that you gleaned out of Alphabet's results that might actually apply to what we hear from Meta?
I think what we're hearing from Alphabet with just the overall stability and to some extent outperformance in ad business, I think that bodes well for Meta. That's kind of stating the obvious that if Alphabet is beating estimates on both YouTube and search, the likelihood of Meta beating even the high end of estimates that we are seeing tomorrow is very, very likely. So I think that's the overall takeaway. But again, Meta, as you said, it's on an island on its own, to be honest.
It is on an island of its own, and we just showed a graphic there with some of the key points here that we probably can expect out of the earnings release and the conference call, and that included the year of efficiency that Mark Zuckerberg has touted, and we already saw some of the fruits of that in the most recent quarterly reporting season here. I guess the question is, how long? Is a year of efficiency just a year, or is this going to carry over into 2024?
I think that's the trillion-dollar question, in my opinion. The biggest debate right now in the entire investment community is how much is Zuckerberg willing to spend next year? Obviously, they have their wind in their sails. Revenue growth has accelerated, will accelerate the next couple of quarters. And they're hitting the AI kind of buzzword bingo in a way that not many other CEOs are playing. So I think with that, if Zuckerberg is emboldened to now spend more next year, whether investors will be able to digest that extra investment is the biggest debate. In my opinion, they'll continue with more efficient kind of growth into first half of next year and probably then start to crank up more investments. That simply means that there is much more runway for the stock right now.
Well, one area that Mark Zuckerberg might be spending more on is legal fees, because more than 30 states have sued Meta for exploiting youth for profit, feeding them harmful content. This is what the state's attorney generals allege through Instagram and through Facebook. And these lawsuits will, of course, take years to sort out. How are you thinking through the kinds of legal costs and years of distraction that this will result in?
In my opinion, the unfortunate reality here is large companies like Meta are almost including some of the legal fees and fines that they'll have to pay as part of their operating expenses. It hurts me to say something like that, but that's the way some of these companies have started to operate, where they're going to blur the lines around what is compliant versus not, and probably include some of $2 billion of fees and fines here and there over the next couple of years. That helps them kind of keep their competitive moat, keep their technological moat in a way that nobody else can penetrate. So perhaps next couple of years we will see some of the fines, not just in the US, but also more so in the Europe, where they have been a lot more focused on Facebook and how threads and all those things as such.
Okay, so it becomes a standard cost of doing business essentially for big tech. One thing I want to ask you about, of course, is AI, because if Meta doesn't want to be left behind this AI wave, it's got to probably start spending more in order to be a leader. Has the turnaround that it's made in 2023, thanks to the year of efficiency, given it enough breathing room to spend and develop new products and new services?
Yeah, absolutely. I think they have started to lean into AI spend in the last 90 days, maybe 120 days. They already have hinted to investors that they're going to be accelerating some of the GPU spend, some of the data center spend that is required to run these massive AI algorithms, which obviously Facebook, given the amount of video that they need to digest on a daily basis, will need to spend a lot more to run those AI algorithms on them as the days progress. So I feel they may have to do a balancing act between the metaverse, the core business, and the AI investments in a way that investors feel happy that the investments in one area are under control while they're leaning into AI. That's the message that we want to hear tomorrow. And if we hear that, then I think we would be big buyers even after the earnings.
I am curious, too, about the hardware side of this. I mean, if they are going to continue moving into the headset realm or something similar to that, whether you're talking glasses or something that's a little bit more streamlined here, we know they've done this before. They've tried to do it before with let's just call it, no, I won't call it a failure, but it certainly wasn't the success that they set it out to be here. Do you think they have, A, the cost structure, and more importantly, the leadership to actually pull that off?
You're just being a bit too friendly. I think I would just say that so far in the last 4 years they have spent somewhere in the range of 65 to 70 billion dollars. That's with a B on the metaverse segment as such, and cumulatively they have earned somewhere in the range of 8 to 10 billion dollars. So they have lost a significant chunk of change in the last 4 years. And 2024 could be a repeat of what we are seeing in 23 as such. So that leash that investors are willing to give to Zuckerberg on the metaverse spend is probably diminishing. Another year of $15 billion plus losses in metaverse might be the last, in my opinion. So that's another messaging that they need to do. How many more years of double-digit billion-dollar losses are they willing to until they actually start making money?
It's quite a change for Meta from a year ago when they are, of course, reeling from the privacy changes that Apple made to iOS. Is that completely over now, Rohit, or is it a reminder that Meta is still very much vulnerable and at risk to factors that are largely out of its control?
I think external factors, the ecosystem factors from Android, iOS, and the way the privacy kind of just the changes in privacy are going to get tighter and tighter as the years progress. That will always be a reminder on how Meta is at the mercy of some of the operators, the hardware carriers, and so on and so forth. But when I look at where Meta is today versus, say, for example, where it was in May of 2021, before the Apple changes, they have probably recovered 80 to 90%. They won't ever recover the remaining 10 to 20%, but that's good enough from an investor's perspective that whatever changes Apple did, they have come back 80, 90%, and the results along with AI should take them over the fence in terms of what investors expect next 6 months. But again, that's a reminder that there are these externalities that can always hurt Meta and structurally speaking, change the way they do business.
All right, Rohit Kulkarni, Roth Capital Partners, Senior Research Analyst. And we should point out, he was just talking about the ads there, Scarlet. Investors, at least on average, looking for a drop in that average price per ad estimate, though revenue is expected to come in at around $33.5 billion. So it's pretty decent revenue growth and a pretty decent profit growth here, at least based on what investors are expecting. And we'll be breaking that down for you tomorrow after the bell. Coming up here on the program today, though, a conversation about the state of the economy with Randy Quarles, former Fed Vice Chair for Supervision. This is Bloomberg. All right, let's talk about regulation in the financial sector. Joining us right now from the Money 2020 conference out in Las Vegas is Randall Quarles. He's the former Fed Vice Chair for Supervision here in the U.S., and now he's the founder of the private investment firm Cynosure Group. Pleased to say that Randy joins us right now from the sidelines of that conference. And Randy, I do want to start off here with this idea of the new regulation that may be coming down the pike now that we're, 7-8 months removed from the initial fallout from the regional banking crisis here in the U.S. We still haven't seen meaningful changes. When do you expect them to come?
Well, I expect they'll be proposed relatively shortly. I do think that, I expect they'll be made final relatively shortly. The proposals, I think, have missed the mark on what's really implied by the bank failures of the spring. The proposals are proposing a lot more capital for the very largest banks in the country, but across the system, they're proposing a lot more internal liquidity, that banks have to keep a much higher level of liquid assets, and neither of those would have prevented the problems in the spring. I think that the Federal Reserve really needs to focus on re-energizing its own provision of liquidity to the banking system and to the financial sector as a whole, as to really solve the pressures that the financial system is under, as was shown last March.
Well, I'm sure, as you know, Randy, there are a lot of members of the FOMC that would push back on that and say that they actually want to pass the baton, at least for some of that, to the private sector itself, meaning the banking sector itself, rather than having it be something that the Fed itself ends up being kind of the first stop of resort, if you will.
Yeah, I think if you're talking about liquidity, that's the wrong way to look at it. We had a system in the United States where banks were responsible for providing all their own liquidity, that the principal source of liquidity was each bank's own resources. That was the system we had through the late 19th century and into the beginning of the 20th century, and it was wildly unstable. There's just not a way that a $200 billion bank could have enough internal liquidity to respond to a $142 billion run, which is what Silicon Valley Bank was looking at at the beginning of March. That's why the Fed was created in 1913, because the system of requiring every bank to have its own high-quality liquid assets and completely rely on those for responding to a run was a definitely inferior system. It resulted in financial crises and economic depressions, and the Fed was created to eliminate all of that. But since the great financial crisis, we've moved back to increasingly requiring that banks not only have a first level of response amount of liquid assets, but that they really are expected to provide all their own liquidity, and that's just not how it should be.
Randy, in retrospect, do you have any regrets about policy choices that the Fed made with regard to the collapse of Silicon Valley Bank and some of the other lenders?
Silicon Valley Bank failed almost 2 years after I had left the Fed. So I guess if you're asking, should the Fed have supervised Silicon Valley Bank differently, most of that was during the period that I was gone, of course. I don't think that the regulatory framework was really at fault. There's been a lot of analysis of that. The regulations were completely adequate to have prevented the failure of Silicon Valley Bank, or at least ensured that there was a proper official sector response. I do think that there is too much of a willingness on the part of the supervisory system in general to focus on non-core issues and not focus on the most important issues, which in the case of SVB was liquidity and interest rate risk and concentration of deposits. And that's something, the supervisor's job is very hard. I don't fault the supervisors for that at all. But it is something that we have to continually work on to ensure that the supervisors are focusing on what's most important and not just trying to boil the ocean.
What are some of the non-core issues that you're referring to that perhaps regulators are overly concerned with?
Oh, there's a great deal of, if you look at, again, today Silicon Valley Bank is the core example, although, two other banks failed in the spring and they were both supervised exclusively by the FDIC and not by the Fed. But if you look at Silicon Valley Bank, the Fed's been very candid in saying, here's the supervisory approach that we had to it. They had 32, I think, matters requiring attention or matters requiring immediate attention, which is the supervisor speak for matters that had been identified for urgent remedial attention. Very few of those had anything to do with what really mattered to the bank, which was liquidity and interest rate risk. And even those that did have something to do with liquidity and interest rate risk were not at the highest level of importance and were more about process as opposed to you must address this risk now.
I know you've moved on from that job as vice chair, but Randy, would you support giving the regional banks a little bit more power, a little bit more autonomy to make decisions with regards to these regulatory issues we're talking about? And I'm just going back to a lot of the criticism that was put towards Mary Daly's way and whether the San Francisco Fed was asleep at the wheel. But there has been this call as to why the reserve banks still need to be dependent on the Fed board to sort of give them the green light to do some of the regulatory actions that they want to do.
Yeah, I'm very much in favor of empowering the reserve banks up to a point. There's a pendulum over decades. This is not just since the great financial crisis, but particularly in the Fed system, but across the bank regulators, where you empower the folks in the field and then you get a lot of differing decisions. So that institutions that are really very similarly situated, it depends on what particular local supervisor they're talking to. So then the system tries to centralize more of the decision making, and that results in slowing down decision making, which was some of what we saw in the Silicon Valley Bank and Signature and First Republic situations, where you just had the center being a bottleneck. So you try to swing that back out. You're trying to strike a balance. After the great financial crisis, the Fed, long before I got there, of course, but the Fed brought everything back into the center again as part of trying to respond to that age-old question of where should the center of gravity be. I think it is appropriate to swing that center of gravity back out somewhat to the reserve banks without undermining the consistency of decisions that are made across the entire system.
Randy, before we let you go, the Fed, of course, is also looking into perhaps revising the cap on interchange fees for that merchants pay to the debit card companies every time a customer swipes their debit card. Is this necessary? And if so, what would reducing the cap, lowering the cap mean for the banking system?
I myself don't think that it's necessary to revisit the cap. The idea of the cap was a very well-intentioned measure that was intended to be pro-consumer, that you could shift some of the surplus from the banking system to the consumer. It's very clear that all that it has done, we now have all of the data and a lot of experience with the first iteration of the cap, and it's just shifted that surplus from the banks to the large retailers. There's no particular reason that the government should care where that surplus goes between the banks and the large retailers. That's for them to negotiate among themselves. None of it is going to the consumer, or very, very little of it. And that would be the case if you tried to further ratchet down that cap today. It would just transfer more over to the large retailers.
All right, Randy, thanks for taking time for us. We're going to have to leave it there. Randy Quarles, of course, he was the first vice chair for supervision over at the Federal Reserve, now at the private investment firm Cynosure Group, and joining us today out at the Money 2020 conference in Las Vegas. Meanwhile, back here in New York, Scarlet and I are going to set you up for what to watch in markets tomorrow. This is Bloomberg. All right, it's been a busy day here, Scarlet, and I think tomorrow could be even busier. We had some big earnings today, some big earnings tomorrow as well.
Yeah, we're done with the big banks in the U.S., but over in Europe, we're going to hear from Deutsche Bank.
Yeah, and back here in the U.S., before the bell, we're going to get a couple big ones, including from Boeing.
From Boeing, from Norfolk Southern, from CME, Hilton. I keep thinking Hilton is private, but that was, a lifetime ago.
Yeah, they're still out there here. Give some respect to Paris there. And after the bell, we got, of course, get some big tech names, including Meta, which we were just talking about.
IBM as well, an old school tech company, but of course, the focus is on advertising and Meta.
You said you wanted Fed speak. Well, guess what? I got the next best thing. How about Bank of Canada speak?
Almost. It's a close second.
All right, a big Bank of Canada decision tomorrow, as well as U.S. new home sales. That does it for us. Thank you for watching. This is Bloomberg.